If you think about the growth cycle, the indicators that we track across the growth cycle are currently suggesting that we have a meaningful tailwind for risk assets right now. Monetary policy suggests we have a modest tailwind for risk assets right now, and the liquidity cycle suggests that it's a modest tailwind right now. So that's all positive. By the end of this year, investors will likely be satisfied with their returns in equities and credit, and investors who have international equities, small cap equities, and cyclical equities will be much more happy with their returns than the investors who kind of stay put in the Qs.
Welcome to Thoughtful Money. I'm Thoughtful Money founder and your host, Adam Taggart. Welcome you here for a very special interview. So if you look at the S&P, folks, the S&P basically is at the same price today that it was before Halloween of last year. So a lot of investors are asking a question. Is this sideways market action that we've had for this many months now, is that the market consolidating before it regroups and then heads to new highs? Or is this a topping out process in the market? I cannot think of a better person to ask this question to than CEO of 42 Macro, the great Darius Dale. Darius, thanks so much for joining us today.
Adam, it's always such a pleasure to be here with your wonderful community. I'm not great. I'm just a guy who works hard with the Bloomberg and produces some great outcomes for our customers, man. I'm really, really blessed to be here. Thank you.
Well, look, I think great is actually an understatement when it comes to you, Darius, on so many dimensions, even personally, which we're going to get to in just a second. But very quickly, we'll talk more about this later in the discussion, but I want to make an important announcement here for folks. I spent a lot of time communicating with the Thoughtful Money audience, both through comments, emails, live events, but also through surveys. And I know through our survey work that the vast majority of the people who watch these videos are self-directed, do-it-yourself, DIY investors. And a lot of what I do on this channel is advise people, hey, if you want some help, go work with one of the financial advisors that I have on this channel often. And that's definitely, I think, a very valued experience for the people who are looking for guidance and some handholding there. But for the majority of people who are watching this channel, what they're really looking for is, hey, what information or what tools and services and solutions can you be providing to me to help me be a better DIY investor? So I'm very happy to announce that Darius's firm, 42 Macro, is now the official endorsed DIY solutions provider for Thoughtful Money, and we'll tell folks a little bit more about that near the end. But Darius, it's such a privilege and honor to have your partnership on this.
The privilege and honor are all mine, sir. When we met a few years ago, I immediately fell in love with you, man, in terms of who you are as a person. I can tell that you care about the people you're serving in your community. And that's something I'm very passionate about. I left my, cushy, expensive Wall Street job a little bit over a half decade ago, I guess, to start 42 Macro, basically on the same premise that you started Thoughtful Money with, which is you exist to narrow that information asymmetry between the buy side and the general investing public. And as someone who's from the very, 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 very bottom of the K-shaped U.S. economy, has been homeless on many occasions, slept in vans, eating food, thousands of meals from food banks throughout the course of my life. It really didn't sit well with me, as I kind of spent the first 12 years of my career, essentially making rich people rich, with my research and risk management signals. And so, we started 42 Macro a little bit over half decade ago to essentially, to correct that, correct something that was really important to me from a mission standpoint, which is to narrow that information asymmetry. We serve many of the top institutions across the global buy side here at 42 Macro, folks I've had longstanding relationships with. And, it's really clear to me that asymmetry, very much exists from a resource standpoint, exists from an experience standpoint. The asymmetry exists from a educational standpoint, just median investor in both cohorts. And it also, that asymmetry tends to exist from an emotional standpoint, EQ standpoint, with regards to taking financial market risk. And so, we built a variety of systematic tools and signals in our toolkit here at 42 Macro to essentially elevate the investing behavior, the habits of the general investing public, so that asymmetry is narrowed we're lifting the kind of the floor, if you will, and the habits, if you will, of the general investing public towards that of our buy side clients. And so we're really proud of this, the solutions we built. We're really and more prouder of the incredible impact that we've had for thousands of investors in 80 plus countries around the world. The testimonials we get, in response to our research and our signals is life changing for me, because it lets me know that we're accomplishing our mission, which is very important to me. So thank you again, Adam. Thank you to the Thoughtful Money community for humoring us. Come check us out. We look forward to you checking us out. And just want to say I'm very, very excited for this, man. Let's dive in.
Well, thanks. And you couldn't have done a better job of demonstrating why, I came to select you as a partner here, just in terms of your integrity, your mission, but also the performance of your results. And I've got a lot of, I know there are already a lot of happy 42 Macro subscribers in this audience. Hopefully, Darius, I expect that there's probably going to be a lot more now that this partnership is official and public there. And folks, if you haven't had experience to Darius's tools and work, you don't just have to take my word for it here. We're going to walk through a lot of his material in the course of this discussion, so you're going to see firsthand exactly what we're talking about. But folks, we'll talk again a little bit more about the how to get your hands on all this stuff near the end. But the shorthand is just go to thoughtfulmoney.com/DIY, fill out the very short form there, and you'll be sent to the 42 Macro experience, and you'll get all the information and all the direction about how you could potentially sign up for their services if they look like they're going to be a good fit for you. All right, Darius, very excited about the future here. Let's roll up our sleeves here and get to the heart of the matter. So in the intro, I mentioned this big question that's being batted around right now, which is the market just seems really stuck in neutral. Where's it going to go once it gets into gear? Are we going to get to new highs on the S&P going forward, or is this a potential topping process? So why don't we start there? How do you want to tackle this?
Yeah, that's a great question. In our view, we do not believe that this is a topping process. You just look at a variety of our signals. One of the things that we do is now cast the market regime. That's sort of our North Star in terms of filtering those signals to retail investors via our KISS model portfolio and to institutional investors via our discretionary risk management overlay across 70 different factors. And we currently remain in a pretty reasonably high conviction Goldilocks market regime, which is a risk-on regime where investors generally get rewarded for increasing the risk in their portfolios. And so this, what appears to be a topping process in U.S. equities, is very much not a topping process in international equities. It's very much not a topping process in U.S. equity factors that have sort of been left for dead by the Mag 7 constituents, small caps, cyclicals, things of that nature. And so when we look at our market regime nowcasting process, those signals, we look at the factor leadership and the factor rotation underneath the markets in terms of the internals. In our view, this is not a topping process. What is more likely occurring, which is something we've been calling for since November 4th, which is chop. We have starting back in early November, we observed a historic degree of crowded bullish positioning in financial markets, particularly in the crowded Mag 7 type, core elements of most investor portfolios. When you think about mega cap tech, mega cap US tech, and that historically crowded bullish positioning has led to a lot of violent unwind, if you will, at the single stock level and at the factor level as well. If you think about software stocks or some of the Nvidia type companies. And so in our view, we don't, this is not necessarily a indication that markets are topping. In our view, we just think this is a run of the mill diversification trade where
so more of a rotation of capital from one part of the market to another.
Yeah, investors are simply using Mag 7 as a source of funds to capitalize other businesses, and we'll talk about why in a moment.
Okay, so you mentioned regime, so we'll get to what regime your model says we're in right now. But real quick, do you expect this, when you say chop, is it more sort of a sideways, capital was in the hyperscalers, now it's going elsewhere, or do you expect kind of a sloshing back and forth through this year? Because there are some value companies now that are pretty richly priced. I mean, it's almost hard to call them a value company because they're trading at such big PE multiples.
Yeah. Yeah, Walmart, I guess, I don't know, Walmart's a value company, but they'll tell you they're not. But yeah, you think about a company like that, yeah, for sure. In our view, we think this rotation trade is durable. And I'll tell you why. So if we go towards the end of our presentation here, where we show some of our views on this we've been calling it a convergence trade, if you will. And so there's sort of two primary drivers of this rotation from Mag 7 to cyclicals to small caps, and most notably, in our opinion, international stocks. There's two primary drivers to that. One, we believe that we are in a secular bear market in the U.S. dollar, primarily as a function of the geopolitically driven supply demand imbalance in the Treasury debt market. That's something that we've discussed, you and I, Adam, on this program on several occasions over the last few years. And so that is ongoing. But another feature that is developing right now and really picking up steam is this AI diffusion theme. And this AI diffusion theme, from our perspective, and I think we have a slightly differentiated view on this relative to consensus, is we see AI diffusion as a convergence catalyst, as a catalyst for convergence, and productivity across sectors, industries, and geographies, a catalyst for convergence and profitability across sectors, industries, and geographies, a catalyst for convergence and earnings growth across sectors, industries, and geographies, and ultimately a catalyst of convergence in valuations across sectors, industries, and geographies from Mag 7 core mega cap US tech into the other factors that investors have largely, stayed away from for most of my career, which began in the global financial crisis.
Okay, and I'm curious, with this convergence, is it productivity and profitability of the outer favor parts of the sectors catching up with the Mag 7 companies, or is in any way is there expectation that the Mag 7 may actually come down in terms of productivity and profitability?
No. This is a rising tide lifts all boats, but from just a mathematical standpoint, and this is where the core of the convergence thing comes from. The companies, the industries, the sectors, and the geographies that have a lower comparative base for productivity, for margins, and ultimately earnings will have a faster growth rate if you shock them with the same catalyst. And the same catalyst is AI. Again, it's coming from a lower comparative base, you're going to have a faster growth rate. So we want to look at this from the perspective of productivity growth. We look at revenue per employee, the year-over-year rate of change of that for the MSCI US index, Eurozone index, UK index, Japan, China, and then the all-country world index, ex-US. And again, we're looking at revenue per employee. It's not apples to apples to productivity, but you don't really get timely productivity statistics across all these geographies. So in order to standardize the analysis, we see that the U.S. has been extremely productive, growing above trend in productivity growth from the perspective of this metric for several years. And at 7%, it's demonstrably outpacing most of the world. Europe at minus 2.2%, the UK at minus 9.2%. Japan's, they've had some corporate reform there over the past few years, so they're mirroring a lot of what we've seen in the U.S., but U.S. outperforming China at 6.2%. And so ultimately, you see there's an opportunity here for the rest of the world to catch up, or at least the delta, the magnitude of the change from where they are currently will exceed the magnitude of the change from where the U.S. is currently. They're all going up. Productivity is, make no mistake about it, AI is going to raise productivity across many sectors, industries, and geographies. And in our opinion, we think the international component of that is where you're going to see the biggest bang for your buck. If we look at this in profitability terms, if we look at the trailing 12-month operating margin, U.S. is far and away, besting the rest of the world at 15%. Europe's at 12.4%. The UK's at 12.6%. Japan's at 10.1%. China's at 12.5%, and then the global equities are at 13.3%. So somewhere between 200 to 500 basis points of potential convergence in margins as the rest of as this cohort catches up to the US. When we look at this in earnings growth terms, what we look at are earnings estimates. So if you look at the next fiscal year estimate, according to Bloomberg consensus, where US is expected to grow earnings at 15.3% above trend, whereas you look at the Eurozone, it's only at 4.9%, 2.7% for the UK, 13.7% for Japan, 6.9% for China. And so ultimately, if we're correct that the diffusion of AI throughout the global economy and the ongoing secular bear market in the US dollar continue, then ultimately you're going to have this productivity feeding into faster margin or into wider margins, which ultimately feed into faster earnings growth expectations for these international companies and cyclical factors where a lot of investors really just don't have meaningful allocations to yet in their portfolios. And the final thing I'll say on this is on valuation. And the reason this is such a, in our opinion, such a high conviction view is that you can just tell just from looking at these relative valuations that investors don't have meaningful allocations to international stocks, to small cap stocks, to cyclicals, broadly speaking, in their portfolios. U.S. These indices are all a bit different in terms of their composition. So you have to find a way to standardize them. And one of the ways with which we do that is looking at the enterprise value to next 12-month EBITDA ratio. You can't really look at PEs because again, you have different compositions. Some businesses are, some indices are asset light, some indices are asset heavy. Obviously, they have different sectoral compositions. You a lot of tech exposure here in the U.S., and so PE is not a great apples to apples metric to look at across geographies. But enterprise value, which does normalize for the asset light or asset heavy nature of these indices, does. And so if you look at the enterprise value to next 12-month EBITDA ratio at 17.9 for the US, demonstrably outpacing that of the Eurozone at 11.6, the UK at 8.9, Japan at 9.9, China's a bit expensive at 14.4, but still way below the US. And then global equities are 11.2. So again, very clear indication that investors aren't here. Yet there's a meaningful catalyst in terms of the diffusion of AI that's likely to cause a convergence in a lot of these metrics. And so ultimately, we think this is a trade that could last for many years, in our opinion.
Okay, great. I was just about to ask that. So we saw international markets start to outperform the S&P last year.
Yeah.
And some might say, well, okay, international stocks had their run here. You're saying, hey, no, we think this could run for a good while, perhaps years.
Yeah. I mean, again, if you're investing on the basis that every day, week, or month that you have to be right on some fundamental theme, I'll tell you right now, you're investing poorly. You're going to have bad results.
Yeah.
You have to understand that this is a multi-quarter, multi-year theme, and so if you give yourself enough time and space to allow the theme to play out, you check in every 6 months, every year. In our view, we think every 6 months to a year, you're going to realize that international equities, and some of these, kind of left for dead factors within the U.S. equity market, like cyclicals and small caps, are likely to continue outperforming. I mean, if you go back to when we highlighted the historically crowded degree of bullish positioning back in November, in early November, not only was it historically a high degree of crowded bullish positioning, but it was all in the same factors and stocks. And so in our view, we just think the Max 7 is unfortunately going to be, for a lot of folks who are, overweight this factor still, it's just going to be a source of funds as investors, more and more investors realize that the rate of change, the speed of earnings growth, the speed of productivity growth, and ultimately the speed of the margin expansion is faster in international equities and faster in small caps and faster in cyclicals. Again, the rate of change, not the levels, but the change is what matters to markets.
Right. And that's meaning that if you're looking for stock price performance, the things that are changing the fast are likely going to have the biggest change in their stock prices.
Bingo.
Yeah.
Bingo.
Okay. And again, just to put this in really simple terms, essentially you're saying, look, we've been promised for, the past couple of years that AI is going to really change the game. We've had a lot of hype to date, and obviously the hyperscalers have made a lot of money because that's where the money was being spent, buying NVIDIA chips, building data centers, stuff like that. You're now saying we're now starting the era where the corporate world is going to start seeing productivity and profitability gains from AI. It's very real, and we're likely going to see the impact of those gains most internationally and in cyclicals and small caps. So that's where you want to be leaning into.
Yeah, not going to. We are. We're definitely seeing it. I mean, we're in the middle of a productivity boom, whether folks want to admit it or not. So if you look at productivity growth right now, we're growing on a quarter-over-quarter SAR basis at 4.9% productivity growth. If you look at this on a 6-month annualized basis, it's somewhere around 4.5%. I mean, these numbers, we're not going to stay at 4 to 5% productivity growth. But the key takeaway from our analysis, which is, in our opinion, pretty robust on this particular topic, is the U.S. is transitioning from a 1.5 to 2% trend productivity economy to a 3% trend productivity economy. And we have historical precedent of doing this before pretty recently with regards to the diffusion of internet technology throughout the economy. If you go back to 1995, when most folks, say that's kind of the beginning of the internet technology diffusion, or at least when it really meaningfully accelerated across, industries and sectors, we were a trend 1.5% productivity economy, whether you look at it on a quarter over quarter SAR basis in the top panel or over year basis in the bottom panel. By 2005, the trend in either statistic, quarter over quarter SAR or year over year, was 3% on a trailing 10-year basis. So we went from, again, trailing 10-year basis of 1.5 to 2% trend productivity growth in 1995 to 3% by 2005. And again, this is with internet technology. Yep. AI, in our opinion, is significantly more productive and productivity enhancing than internet technology. I mean, this period here where productivity went from 1.5 to 2 to 3, we're talking about Napster and MySpace and Ask Jeeves and not can we redo this entire business process and or develop code that puts this entire industry out of business. This is a much more powerful technology in terms of enhancing the output per hour worked, especially in the context of the likely depressing impact that we're going to see AI diffusion have on the labor market. You're just going to have less hours worked and more GDP. So ultimately, we think productivity growth is likely to trend higher, if not explode, in the coming years.
Okay, and I want to talk with you here soon about the depressive impacts on the labor force. Sure. Before we get to that, though, it sounds like if I'm asking you to take the over or under on GDP growth this year, you're probably going to take the over, correct?
Way
GDP
over.
Growth expected way over. Okay.
Way over.
And we're talking just about AI right now, but if you listen to the current administration, not just the president, who obviously makes really big, bold claims, but folks like Scott Bessent and Howard Lutnick and a lot of cabinet advisors that are actually leading the charge and executing a lot of the economic policies, they are telling a similar optimistic story. And they're definitely saying, look, we have spent 2025 laying a lot of foundational work to boost the economy, to drive material new economic growth, in this coming, quote, golden age, right, of America. So how much of your confidence of, hey, I'm going to take the over on GDP is due to just the AI effect that we're talking about, and how much, if any, is also due to the deregulations, the trade deals that have been struck, the foreign capital that's supposed to be coming into here, the tariff revenues, the tax extensions and additional tax cuts. You could make an argument those are providing additional serious tailwinds to economic growth going forward. Are you in that camp as well?
We're in all the camps, and that's what Paradigm C is. And I think last time I was in your program was at your fall conference, but the previous time was on. I think I was on in June of last year, a couple of months after we had authored the Paradigm C theme. So for those who may not be familiar with our Fourth Turning Inspired Paradigm framework, Paradigm A is the the advent of the geopolitically driven supply demand imbalance of the Treasury securities market. And so there's sort of, when you get to a certain level of debt to GDP or just debt in general, in terms of the squeeze, the impact that debt service has in terms of squeezing out consumption and investment, once you get to that point, we call it the debt disease. There's only really three solutions: you can cut, you can grow, you can print. And so we saw the attempt to cut with Paradigm B. That's what we call the cut phase of this three-pronged sequence. We saw that attempt with Doge and the tariff. The Liberation Day, I would say, fiasco last year. They pivoted very quickly out of that to trying to run the economy hot, the growth phase, which is Paradigm C. Paradigm D, which is, in our view, where we're ultimately headed with all this in the coming years, which is the print phase. In our opinion, Paradigm D is also quite bullish from a nominal GDP perspective, but Paradigm C is sort of the sweet spot from a real GDP perspective. And so ultimately, noticing that pivot. And Treasury Secretary Bessent is a former client of mine. I understand, I'm well aware that he understands a lot of what we're discussing today, and is why they made the pivot. Ultimately, we're currently experiencing a rare confluence of meaningful fiscal easing, meaningful monetary easing, and meaningful deregulation. It almost never happens. You go back to probably early 2000s is the last time we saw that confluence of events, meaningful fiscal easing, meaningful monetary easing, meaningful deregulation. Obviously didn't end well in terms of creating a housing bubble and a global financial crisis. However, however, it did create some very positive outcomes on financial markets, particularly for international and small cap and cyclical factors in the equity and credit markets, which is exactly where we've been guiding our global investor community to participate in recent months.
Okay. And I've been sort of reminding folks that I've been deliberately asking a lot of experts like you know, will these policy factors add tailwinds? You're saying absolutely. And one of the things I'm trying to underscore for people is you don't have to like this, right? You might be against the current administration's policies, but when you do these things, when you fiscally ease materially, when you monetarily ease materially, and you deregulate, that just generally is bullish for the economy.
100%. I mean, you got to take your you don't bring a politics knife to an investing gunfight. Like you just can't do it. Look, we're in a fourth turning. You're probably everyone listening to me talk right now is probably going to get more disgusted by politics as we move forward in time. So if you allow that to cloud your judgment and ultimately, cause you to make negative net present value decisions in your portfolio, that's a problem, and you have to elevate your investing habits to remove the influence of politics from that. If we can go back to kind of those three core drivers, just a couple things to highlight on that. So we'll start with deregulation. In our opinion, people to throw around the word deregulation, but in my opinion, it's a very loose and squishy thing when we talk about it from an investing standpoint, because there's no time series for regulation or deregulation, right?
Right.
So you have to figure out how it's actually impacting the economy. And from our perspective, the biggest lever that the Treasury Secretary Besson is highlighting that the administration is pulling from the set of deregulation is bank deregulation. Nikki Bowman, the Fed's chair for bank deregulation, is very much in line with Treasury Secretary Scott Bessent's drive to meaningfully deregulate the banks, and we're already seeing it in the data. So this chart here shows commercial bank loans and leases, which from a growth rate perspective had been left for dead for nearly 2 years, from basically early 2023 all the way through early 2025. Well, if you look at the most recent growth rates, the commercial bank loans and leases are now growing 9.2% on a 3-month annualized basis and 6.8% on a year-over-year basis. Both of those numbers are well above trend. The light blue dotted lines in these charts indicate the trend. The blue bars indicate the 3-month annualized rate of change. The black line, if there is a black line, is the 6-month annualized rate of change, and the red line is the year-over-year rate of change. So just remember that if you ever see these charts from us. And so we were already breaking out from a multi-year consolidation, if not, kind of recession in bank credit growth, largely being driven by the large banks, but you're actually starting to see small banks get involved as well from an acceleration standpoint. So in our opinion, this deregulation push is already having economic impact in terms of reflating the economy. Another driver of this paradigm C upside.
Sorry to interrupt while you're getting to your next slide.
Yeah, go ahead.
Basically, loan activity is, I'm going to guess, correlated pretty much on a 1-for-1 basis with economic growth?
No, not at all. No, it's actually it's much lower than that. However, it's a co-integration. So whenever you have above trend loan, the correlation is not high, but the co-integration is. But they are co-integrated. When you have above trend loan growth, you tend to have above trend economic growth, and vice versa.
Okay, so great. That's more or less the spirit of what I was asking. Yeah.
Yeah, exactly. So you can't use it. I wouldn't build a linear regression model with it, but you can certainly use it to anticipate going from an above trend or from a below trend to an above trend condition in the economy, which is exactly what we're calling for. With an expectation that growth is likely to come in at 3%, perhaps even higher than 3% on a real basis here in 2026, which is 40% higher than what consensus currently expects.
Wow. Okay. So you're thinking the market still really has to wake up to what you've already sussed out about what the future is going to be.
Well, they're going to wake up or they're going to get woken up. Either way,
they'll wake up one way or another. Yeah,
exactly. Yeah, either way, if you wake up in July and you're underperforming international equities and small caps by 20, 30 percentage points, and they'll change their positioning then. I'm telling you here on February 27th, and I'm not sure when you're going to publish this, but we're recording on February 27th. I'm telling you here on February 27th that growth is likely to come in much faster than consensus expects on GDP, which will obviously create upside risk to earnings expectations, both domestically and abroad. And going back to where we started the conversation, we just think the convergence factor with regards to diffusing AI throughout the global economy is likely to cause, from a lower comparative base, international equities and small caps and cyclicals growth rates to the rate of change to be a greater magnitude than that of where the factors where everyone's already long.
All right. Look, great. And I'm biting my tongue on a question around your KISS model and how you will play this through KISS, but
Yep,
we
we'll
got more wood to chop, and I think I interrupted you. You were going to talk about inflation here.
Yeah, no. I was just quickly highlighting sort of the three core pillars of Paradigm C. Again, when we pivoted to Paradigm C back in April, we recognized that the administration was beginning, April of 2025, we recognized that the administration was beginning to pull the levers of fiscal easing, monetary easing, and deregulation, which will ultimately, when you put those three things together, you're going to wind up with an above trend growth rate in the economy, especially in the context of the upswing that we're the cyclical and what we believe to be is a structural uptrend in productivity growth. So obviously another feature of this paradigm C, if you think about it as a three-legged stool with fiscal easing, deregulation, and monetary easing, another leg of that stool is the monetary easing. Obviously, we've seen almost 2 whole percentage points of rate cuts, 175 basis points of rate cuts by the Federal Reserve, and we're still dealing with the lagged impact of that monetary easing filtering through the U.S. economy. And by the way, the markets continue to price in 2.5 rate cuts for 2026. The Fed, there's only at 1 rate cut for 2026, but we ultimately believe that our view on inflation, we talk about that shortly. Our view on inflation is that the inflation dynamic is likely to cool off, continue cooling off, and ultimately the labor market dynamic is likely to remain squishy, if not get squishier, in the context of AI, which will give the Fed ample scope to eventually ease monetary policy again here in 2026. So you have that tailwind, obviously the bank deregulation tailwind, and then ultimately the fiscal tailwind is a big deal as well. So one of the things that I think investors missed last year and was contributory to the slowdown in growth and ultimately contributory to the slowdown in the labor market was the fact that we saw a pretty meaningful fiscal retrenchment in 2025. We had, so if you look at the budget deficit as a percent of nominal GDP on a calendar basis, in 2024, it was 6.8% of nominal GDP. It narrowed 140 basis points to 5.4% in 2025. And part of that narrowing was obviously the advent of tariffs. We saw customs duties up 235 percentage points in 2025. And so that helped narrow the budget deficit a meaningful degree. Transitioning to fiscal 2026, so that which began in October, so we have 4 months of data for fiscal 2026. When you analyze the budget deficit on a fiscal year-to-date basis, so transitioning from calendar year-to-date to fiscal year-to-date, we are now expanding materially. So on an annualized fiscal year-to-date basis in fiscal 2025, which ended in September, the budget deficit, on an annual rather, the budget deficit was 5.7% of GDP. On an annualized fiscal year-to-date basis through the first trimester of fiscal 2026, the budget deficit is widened to 6.7% of GDP, so 100 basis point fiscal expansion. And so we have monetary easing, we have fiscal easing as a function of the one big, beautiful or ugly bill, depending on what side of the political aisle you live on. I could care less. I'm trying to make money. So we have the fiscal thrust from ABA, as well as the monetary easing, the lagged impact of monetary easing, plus the incremental monetary easing we're likely to get that's currently priced in, as well as the ongoing bank deregulation dynamic. In our view, this expectation that growth is going to come in at 2.2% on average in 2026 and 2027, in our view, is roughly 40% too low. And until that delta converges, we just think there's upside risk in financial markets.
Okay, let me ask you this: just on the monetary side, I guess the question is just what are your thoughts on Warsh? Is he a material factor here, or will he just be sort of continuation of what we've already done? He's kind of known as an inflation hawk. It sounds like you're not that worried about inflation here in the near term anyways. But what do you think about Warsh as a nominee here and his impact on your outlook?
Yeah, to me, I think that's one of the one of the key questions in all of global financial markets, because Kevin Warsh could potentially represent a sea change with regards to the Fed's reaction function, particularly on its balance sheet policy. Warsh has made several comments across multiple years now about the Fed's footprint in the economy and financial markets, specifically as it relates to the Fed's bloated balance sheet. This is a comment that he made last year in May, where he said, I would say the balance sheet is trillions larger than it needs to be. We can't make this change overnight, but if markets knew that our objective was to get the balance sheet that was as riskless as possible and as small as possible, we would get there in due time. And with the strategy, I think markets and market participants could well adjust to it. Now, this is, relative to a lot of the non-Bayesian narratives that, still exist in the crypto asset class, that's a shot across the bow, in our opinion. And so you, as an investor, I don't know that we know enough yet as it relates to Warsh's, gumption when he actually gets in the seat, right? Because we saw this tough talk out of Secretary Bessent, respectfully. Sorry, Scott. We saw this tough talk out of Scott Bessent with regards to Janet Yellen's dovish net financing policy for over a year prior to him assuming the role of Treasury Secretary,
and then continuing it.
Yeah, and then since he's became Treasury Secretary, now he's back at kind of rubber stamping the policy. If you want to look at in terms of Fed's bills divided by total marketable Treasury debt. I mean, it's just been static at 22% for years now, kind of taking the baton from Janet Yellen. So our fellow Yelly Janet Yellen. So I'd love to get us all in a room and have a chat about this at some point. So the key takeaway is, Warsh obviously made some very hawkish comments with regards to the balance sheet in recent years. Obviously, at $6.6 trillion, that's a long way to go down relative to where the Fed was kind of when Warsh was on the Fed balance sheet, when he started the Fed, $1 trillion level. Again, this chart's in log scale. So that's a long way down. But I think there's a silver lining here that I think investors might be missing at the current juncture, which is two things. One, the FOMC is a committee. Warsh is not going to be able to come in and strong arm the committee into doing things that it doesn't want to do. So he's going to have to create some really credible cases for why to justify a lower policy rate in line with what he promised the administration, but also to support moving the balance sheet down. So one of the things we think he can do in this regard is to sort of piggyback or if you will, on this bank deregulation initiative. Because at the end of the day, the Fed can't meaningfully reduce its footprint in the economy and financial markets without causing a significant disruption in the economy and financial markets, particularly through the repo market, the repo channel. Banks, as a function of a lot of the regulation we've seen from a Basel standpoint and Dodd-Frank standpoint since the global financial crisis, have that regulation has caused banks to increase their demand for reserve assets. And so the Fed has essentially had to supply bank reserves in order for banks to sort of not, I guess, tighten credit enough, tighten credit in a way that, to increase their demand for reserve assets in a way that would ultimately tighten credit in the real economy. Well, so ultimately, in order for Kevin Warsh to thread the needle on reducing the Fed's footprint in the economy and financial markets, you're going to need to meaningfully relax bank regulation in a way that allows banks' assets to grow meaningfully such that banks can now become the buyer of last resort for treasuries instead of the Fed. Because again, we are still in an era where there is a persistent geopolitically driven supply demand imbalance in the treasury securities market. So someone has to buy this paper. And ultimately, we think it's going to come back to the commercial banking sector. So one final thing I'll say on this comment, if you look at the growth rate of commercial bank loans and leases, not loans, leases, this is total assets now. So it includes loans and leases, it includes treasury and agency securities and other dynamics. We're now at 7.6% on a 3-month annualized basis, 4.9% on a year-over-year basis. I mean, these numbers are much faster than anything we had seen in recent years. And so ultimately, we think that, this is the channel that they're going to use to, kind of essentially shrink the Fed's footprint. And if they could do that really well, and we've seen there's ample scope and ample time series history of this outcome in the past. You go back to the early 2000s, commercial banks were 33% of the market for marketable treasury securities. They're now down at only 15%. The Fed at one point was 25%. They're now down at 14%. And so, ultimately what we're essentially calling for is the red line, which is commercial bank share of the marketable treasury market to go up. The Fed's share probably flat over time. And as long as commercial banks are going up and foreign central banks are going down, you can probably arrest the rate of increase in the private non-bank sector, which has grown 22 percentage points since the end of 2021 to 58% of the marketable treasury debt market. That's a very unstable disequilibrium. And I think Kevin Walsh is aware of that. I mean, any central banker would be aware of that. Certainly Scott Bessent is aware of this. And so ultimately, we just think that they're going to find ways to pull the commercial bank lever in order to kind of ease some pressure on the Fed and commercial banks broadly in terms of capitalizing the treasury market and ultimately at their demand for reserves.
Okay. So I'm excited to ask you this question because you said that Scott Bessent, Treasury Secretary Scott Bessent, was a former client of yours. So you perhaps may know the man a little bit more than the rest of us who just read the headlines and see his interviews.
Yep.
You know, he led the search for Powell's replacement. Clearly must have been a very influential voice with the president in terms of trying to, in terms of landing on Warsh as the nominee. And in that search process, I was surprised pleasantly to hear Treasury Secretary Bessent talk about how he thinks the Fed has been guilty of mission creep and, basically expanded its mandate too much and, created some price deformations in the marketplace and potential wealth inequality as a result of all that.
Mm-hmm.
And talked about, hey, in the future, we're looking to see if we can actually kind of, shrink the mandate of the Fed and maybe more like something like it was initially created for. How serious is he around that? And do you think with the selection of Warsh, he's deliberately picking somebody to partner with him on doing exactly that?
Yeah, they're very serious about this because ultimately Warsh is a monetarist who understands the role of money in monetary setting monetary policy, right? I think that's to me that's the number one thing. I mean, there's a core belief amongst the Warsh Bessent community in financial markets, and I have the great privilege of meeting with a lot of institutional investors across the global buy side. There's different cabals. There's the high quality compounders cabal. Then there's the kind of the Keynesian economist cabal. Then there's the right leaning kind of Hoover Institute economists, Chicago Booth cabal. There's all these different cabals across the global buy side. And in the Kevin Warsh, Secretary Bessent, kind of Larry Kudlow, if you will, cabal, they believe they're monetarists. They believe that the Federal Reserve was contributory to this, explosive growth in prices that we've seen in the pandemic, in this pandemic, business cycle. You go back to 2020 and 2021, and the Fed doesn't talk anything about this. Nobody at the Fed acknowledges this. They'll blame Russia's invasion of Ukraine, which they still do to this day. They'll blame the pandemic supply chain disruptions, which they still do to this day, but they won't blame the fact that the federal budget deficit, grew by 5.9, or federal debt grew by 5.9. We accumulated $5.9 trillion or $6 trillion in deficits in 2 years, and the Fed monetized almost 60% of it. And so Warsh has explicitly called this out in a series of statements in terms of the Fed's ridiculously easy monetary policy, which, if you look at it on a relative to the Taylor rule, was even easier than what we saw from Arthur Burns back in the 70s. And then that's not even including the balance sheet. Obviously, this is easier than what we saw with Arthur Burns back in the 70s. The Kevin Warsh understands this. And so they ultimately are attempting, if you will, to put a cap, put guardrails around what the Fed can do in terms of creating an inflationary dynamic in the economy. If you go back to the 60s and 70s, money supply was a perfect leading indicator for all the spikes that we saw in inflation. And so ultimately, we think Kevin Warsh and Secretary Scott Bessent ultimately want the money supply growth to not come from such aggressive, broad, large-scale asset purchase programs that are, can be easily politically influenced and manipulated. I just think they want to be the economy to go back to how it used to operate prior to the GFC, which is banks were the largest determinant for the growth rate of money and the business cycle. And so ultimately, and as a function of that, we generally had pretty stable outcomes in the economy, barring the GFC. But I don't know that they could get there overnight. But in my opinion, I think that's where we're going. And you as an investor, you had to put that hat on and say, okay, what was the world like prior to the GFC? What were the factors that led in the equity and credit markets? Where were the flows? How did the currencies behave? How did fixed income behave? In our opinion, we think that's where the world's going.
Okay. So you mentioned earlier that you're expecting substantially more higher economic growth this year than the street seems to be expecting. We talked about the reasons why. Let me ask you this. So we just had the recent Supreme Court ruling basically striking down the tariffs or declaring the tariffs unconstitutional that the administration has used so far to date. The administration is saying, hey, it's not an issue. We've got other ways in which we can apply tariffs on countries. Um, do you have any concerns about this, curveball to the administration's intended policies, or do you think the administration's correct that they've got just other venues to do exactly what they want to do here?
I don't think it matters. I'll say the same thing I said in April of last year. We were telling clients to get long before everyone has to capitulate to the upside, which when I was on your show in June of last year, that's when we first saw the big first wave of upside capitulation that we were calling.
Yep.
It doesn't matter. Tariffs only impact a very small percentage of the economy, and that percentage of the economy is not necessarily represented in financial markets. This is 10% of nominal GDP and 14% of employment. It's goods imports are only 11% of nominal GDP. So if you're talking about the effective average tariff rate is somewhere around 10% and goods imports are somewhere around 11%, this is like 1% of GDP. You know what I mean? Like, we're talking about like 1% of GDP in terms of the tariff regime. It's really not that much. We're focused on the other 99% of GDP, the other 99% of GDP, particularly the productivity dynamic. We go back to productivity, which I think is going to have a much bigger influence over financial markets than the tariff regime. We index this back test on productivity relative to each of these troughs in the productivity cycle. There've been 9 kind of productivity cycles since we have the data going back to the 1940s. And the current productivity cycle upturn is outpacing that of the internet technology diffusion productivity cycle upturn, which is one of the best of all time.
Wow.
So 0 here represents, the trough in this chart here, the year-over-year rate of change in productivity growth, and 40 would be 40 quarters from that, and minus 40 would be minus 40, so 10 years prior and 10 years post. The internet technology productivity cycle, again, was one of the best of all time, rivaling the 1950s and 1960s productivity cycles upturns, which were, we'll never do that again. We're electrifying the economy. We're, internal combustion engines were, going everywhere. We had investment in human capital coming back from the war and the GI Bill. There were so many reasons why productivity exploded higher back then, but we're already outpacing the internet technology productivity cycle currently. The current productivity cycle, which began in Q2 of 2022, we're outpacing the internet technology, which again is one of the best productivity cycles upturns. So to me, this is the 99% of the economy that no one's talking about, whereas the 1% of the economy in terms of the cumulative impact of the tariff regime is what the media wants us to focus on. They want to sell us, things that tickle our amygdala and get us to click and subscribe and get us to buy and interact with the ads that they put on their platforms. But the reality is that stuff doesn't matter. What matters is growth, inflation, monetary policy, fiscal policy, liquidity, and positioning. Those are the 6 key cycles that influence the momentum and dispersion within and across asset markets. And if notice I didn't say tariffs, notice I didn't say geopolitics, notice all this stuff that the media tries to get us to interact with. Yeah, it's great for a headline, but it doesn't matter in terms of the trending momentum and dispersion within and across asset markets. This stuff is what matters here in our macro weather model.
All right. Well, folks, when I talked earlier about endorsing 42 Macro as the DIY solutions provider for thoughtful money viewers, hopefully by now you've just been overconvinced of the level of rigor and analysis and detail and intelligence that goes into all this. Darius, a couple of things. First off, I want to give you kudos again. You were a lonely bull back at the end of 2022, going into 2023. So that was the period where everybody was 100% convinced we were going into a recession. You were one of the very few voices saying, I don't think it's going to happen. In fact, I think things are going to be pretty good for investors from here. You were proven correct. You held that for a couple of years, being proven correct all along the way. At the beginning, early in 2025, you came on this program and said, hey, Adam, I'm actually now pretty bearish. And of course, then we had the Liberation Day, kick to the shins for the markets. And then to your point, relatively quickly after that, you said, hey, I actually think the market's way overreacting here. I think the tariffs are not going to be that big of a deal. And I think for a lot of structural reasons, a lot of things are on sale right now. Let's get in the pool. You proved again to be very right on that. I get the sense now, I don't want to put words in your mouth, so correct me if this is wrong. I get the sense that you are a raging bull economically looking out here. That doesn't necessarily mean that the markets are also going to perform as well. Now, you talked about how you think a lot of the market outperformance is going to be driven by AI, and it's going to be in the international stocks and the cyclicals and the small caps. But valuations are getting pretty rich here in certain parts of the market, as we talked about. Does your enthusiasm for the economy this year translate into enthusiasm for the general market, or is it largely going to be concentrated in the areas that you mentioned there, international cyclicals and small caps?
Yeah, it's an excellent question, and thank you for that. Kind recap of what we've been over the past few
It's not
years.
kind. It's just what happened. It's just a
No, yeah,
historic
we've
tape.
look, we've like I said, I spent the first 12 years of my career making rich people richer. I'm really blessed to have spent the last half decade making everyone richer, including our very wealthy buy side clients. No, but again, we've had a really blessed run here. We were appropriately bearish heading into 2022. We were appropriately bullish at the beginning of 2023. We were appropriately bearish at the beginning of 2025, and then we pivoted back to being bullish back in April of last year. So we've been on the right side of market risk for a very long period of time now, and it helped our customers maximize a tremendous amount of upside capture in those bull periods and minimize a tremendous amount of downside capture in those bear periods. And so again, really blessed by that. But again, there's no luck involved. We're very, very extremely systematic investors. If it's not obvious at this point, it'll be obvious by the end of this interview when we unpack our KISS model portfolio. But from what I can say in terms of answering your question, we continue to believe that Mag 7 type names, again, the concentrated exposure that investors had to US tech, which they should have had if they wanted to outperform for, I don't know, the last 10 to 15 years, that concentrated exposure that a lot of folks have will, in our view, continue to be a source of funds to capitalize other factors with, namely international small caps cyclicals. If you can remember, international small cap cyclicals, or in some order, we think that's the most appropriate trade. We think that the upside in those factors, in terms of responding to a lot of these positive economic developments, is likely to be greater than it is in terms of the Qs or something like that. So that's our general belief here. And in terms of just a broad market risk, so we refresh our macro weather model for the members of our global investor community on a daily basis, 6 days a week. Here at 42 Macro, and as you can see by the composite signals here in the middle of the page, the risk-taking environment is still good. There's a high probability of sustaining a risk-on market regime over a short to medium-term time horizon, which is 1 to 3 months in our risk management nomenclature. When we look out further than 3 months, that's when we layer on our fundamental research views, which are broadly bullish. And so, if you think about the growth cycle, the indicators that we track across the growth cycle are currently suggesting that we have a meaningful tailwind for risk assets right now. Monetary policy suggests we have a modest tailwind for risk assets right now, and the liquidity cycle suggests that it's a modest tailwind right now. So that's all positive. Where we're getting some sort of push-pull, and part of the reason why we've seen more violent, choppy, kind of aggressive rotation type flows, particularly in the factors that are being rotated out of, is because we do also have some headwinds currently. The inflation cycle is currently a modest headwind on net. The fiscal policy cycle is currently a modest headwind, although it's likely to transition to a meaningful tailwind in the coming months. We think the inflation cycle will become a modest tailwind in the coming months as well. But ultimately, the number one thing that continues to be an issue for financial markets, and particularly U.S. equities, U.S. credit in particular, is the fact that we have such crowded bullish positioning. It's not as crowded as it was back in November when we first called it out and said, hey, markets are going to start to be very choppy, especially if the Fed does not fix this repo market issue that we had been highlighting, which they ultimately pivoted to reserve management purchases on December 10th to address. And so, we continue to see that choppy nature and that rotational nature of the markets, that churn, kind of violent churn that we've seen, that's likely to continue. Because ultimately we don't have this massively meaningful tailwind in liquidity that's kind of rising tide lifts all boats like we used to. And that may be permanent question if Kevin Warsh represents a meaningful downshift in the Fed's footprint in the economy and financial markets. And of course, they get the bank deregulation wrong. I'm not expecting them to get the bank deregulation wrong. I think it's all likely to end well from the perspective of our paradigm C theme, but that doesn't necessarily mean markets have to price it in a linear straight line. It just means that, By the end of this year, investors will likely be satisfied with their returns in equities and credit. And investors who have international equities, small cap equities, and cyclical equities will be much more happy with their returns than the investors who kind of stay put in the Qs.
Okay. All right. Well, great, succinct, and very actionable. All right. So we're making our way here to your KISS models outputs. Is there anything on the macro or fundamental side that's really burning brightly on your radar that I just haven't thought to ask you about yet that's worth talking about?
Yeah, let me just click through. We have not talked about AI's impact on jobs. To me, that's the number one thing that we have to figure out, not just as investors, but as a society.
As a
What are
society.
we gonna do about this? And again, I had so much pushback from institutional investors for the past 6 months on this theme, but I don't know that you can credibly push back anymore. I mean, they're literally shooting, they're taking software stocks out like Microsoft and Salesforce, and they're selling them like they're going bankrupt.
Mm-hmm.
If they're going to sell those companies because of AI disrupting them, don't you think that the employees that work at those companies are going to get disrupted?
Yeah. I mean, the day we're talking here, Darius, you probably saw the headline about Block, which,
Yeah,
which
yeah.
voluntarily just fired half their company because they're like, we just don't need them. The AI is helping us be that much more productive.
And the stock went up 20 something percent. What does that tell you? Nvidia beats numbers, blows out numbers, raises guidance, stocks down 6%. Block cuts half of his workforce, stock up 20%. I can't be more clear about what that is signaling from the perspective of the long-term risk to the labor market. Now, again, this is not like we're going to go from 4.3% unemployment to 5.3% unemployment in 6 months. That's not what's going to happen. But in our view, we think AI is going to be a catalyst for a durable continuation of this low hire, low fire dynamic in the labor market. And I'll show you a few charts on why we believe that. So we'll start here on jobless recovery. This is the top panel shows private sector job openings. The most recent JOLTS report we got is from December. And in December, private sector job openings collapsed 62% on a 3-month annualized basis.
Wow.
Down 62% on a 3-month annualized basis, private sector job openings. If you look at private sector employment, true private sector employment, so something like true private services, which strips out government and government adjacent sectors like the federal, state, local governments, healthcare, education, and social services. So just the private sector economy that is not, where the government isn't the main employer or the main buyer of the service. We've basically had no growth for over 2 years now in true private services payrolls. They're currently growing at 0.1% on a 3-month annualized basis, 0% on a 6-month annualized basis, and minus 0.1% on a year-over-year basis. This is almost 3 years now where there's been no employment growth in true private services payrolls. I'll show you another chart on this. If you go and you look at the total amount of employment that has come from this government and government adjacent sectors, prior to COVID, it was about 31% of total employment growth came from government and adjacent sectors, which again, federal, state, local governments, healthcare, education, social services. The last 2 years of the Biden administration, it was 84%. The first year of the Trump administration, it's 144%. That means 14 out of every 10 jobs that are being created right now are coming from the government and government adjacent sectors. There's no dynamism in the private sector labor market economy. And so ultimately, that lack of dynamism, you can continue to see it in this low fire rate, where the private sector hires rate is well below trend at 3.7%. Private sector quits rates well below trend at 2.2%, and then the private sector layoffs and discharges rate is well below trend at 1.2%. If you look at the unemployment rate in terms of the unemployment rate, we're at 4.3%. If you want to add back the folks who left the labor market, in terms of the folks who left the labor market, in terms of the decline in the employment to population ratio relative to the all-time high, we already be at 5% in terms of unemployment. In terms of unemployment rate right now. And this is, prior to AI really making a meaningful dent. I think by this time next year, it'll be pretty clear that companies don't need to hire people at the rate that they used to if they're in the white collar industries, which is roughly about 50% of total employment.
Wow. All right. So, big picture, this just adds tailwinds to the productivity gains of companies going forward. So good for corporate profit margins, good for presumably for shareholders in those companies, but rough for rough for employees, right?
But for society, it's not
Yeah,
good.
yeah. I mean, at some point, this potentially gets bad enough that I mean, society has a real underemployment problem here, right?
Yeah, yeah. I mean, look, I think that's a couple trades away from now. I think the trade now is productivity equals faster profits and faster growth, and ultimately faster capital, appreciation of capital. That to me is the current trade. The next trade is, what do we do? What are we going to do with all the people that we used to employ?
Right.
I have thoughts on that, but that's probably not for this discussion. We'll have a discussion about that in the future when it's time. But I mean, just kind of landing the plane on all this. The long-term unemployed as a percent of total is at 25% now. And it's been gradually rising for years now. We basically troughed in when ChatGPT came out, unfortunately. And that 25% as a percent of the total unemployed is compares to a long run mean of 16.5%.
Hmm.
This number, in our view, and according to our analysis and according to the data that we can currently observe, and if you want to look at the model we built, if you look at employment growth, there's this kind of narrative out there that, okay, the president closed the border and he's enforcing immigration policy, and so that's now causing a cyclical downturn in the what they call it, the break-even rate of total employment or employment
Mhm.
growth. You've heard that argument posited by several economists on Wall Street. Completely disagree. I mean, that's just it's factually incorrect. The civilian labor force is currently growing at 1.8% on a year-over-year rate of change basis. That's a 70th percentile value with data going all the way back to 1948. And so historically, when the civilian labor force has grown at this rate of change, in 1.8%, the median rate of change of private non-farm payrolls growth is 2.3%. Private non-farm payrolls growth is growing at 0.3%.
Wow.
So there's already a dramatic underperformance in private non-farm payrolls growth relative to the 70th percentile growth rate of the civilian labor force. And so, in our view, this AI's impact on the labor market is already happening when you look at labor demand from the perspective of job openings, labor demand from the perspective of actual employment, and then ultimately labor demand from the perspective of can people who've been let go actually find a job in terms of long-term unemployed as a percent of total. And the answer, unfortunately, for society is not good.
So, Darius, I know that a lot of viewers on this channel have a lot of concerns about this future for AI, many for themselves, but many for their children. And I would love to do a deep dive on this topic with you at some point in the future, whenever works in your schedule, whenever you think appropriate. Because I just think there's such a hunger for just trying to figure this out and to reduce our potential future vulnerability to this. Um, I look at all this and I have lots of worries about where society may go, but just in a very simplistic way, I think, okay, look, companies are going to be more profitable. Their stock prices are probably going to do great.
Right.
So everybody who's on the lower end of the K-shaped economy, they don't really have assets, right? So asset owners are going to do great in this future. Those that don't have assets, well, all they really got is their job. If their job goes away, what do these folks have? So that's kind of the core concern I have. It seems like you share that as well.
100%. I mean, that's in our view, that's exactly where we're going. We've already gone there without AI. There's been an all-out assault on labor share of national income, which is the blue line here in this chart, for decades. Partially as a function of globalization, but the number one reason we think there's been an all-out assault is because back in the 80s with Reagan and Thatcher, they did a lot of great things in terms of the neoliberalism era that they kicked off, did a lot of great things in terms of boosting aggregate output, GDP, corporate profits, the increase the wealth of the economy in aggregate in terms of the stock market and whatnot. But it did create a lot of issues from a distributional standpoint. And one of the biggest issues it created from a distributional standpoint is the relationship between labor and capital.
Mm-hmm.
That's the ultimate K in the K-shaped economy. You want to just draw a horizontal line here. We've been going straight up and to the right in terms of corporate profits as a percent of gross domestic income. We're going straight down and to the right in terms of labor share of national income. And so ultimately, the true promise of AI is not just efficiency gains. It's how can I replace my biggest cost of most companies' biggest cost is labor. And so
Mm-hmm.
the promise of AI from the perspective of the capital holder is that the blue line, which has been trending lower for decades, is a function of the assault, this prioritization of profits over people. That's what neoliberalism really meant for society was, hey, we'll fix inflation, but guess what? We're going to do it in a way that prioritizes profits over people. So now we're at the logical end of that extreme, and now we're starting to have some pretty extreme outcomes. We could have the rate of change, the slope of the blue line accelerate or decelerate or go down faster, and the slope of the red line go up faster. That's in our view that this is the current trade. The change in these slopes, to going down faster in blue line terms and up faster in red line terms is that's the current trade. And I don't know when that trade ends, but it's probably got some legs, at least 12 to 18 months in terms of pricing it into financial markets. And the next trade is, okay, when we get to a low enough level here, what's the political response? What's the geopolitical response? Because I'll tell you right now,
what's the fourth turning outcome here?
100%. I was just about to go there. I'll tell you right now, you study the greats like Neil Howe, my former colleague and a friend. You study the greats like Ray Dalio. You study the brilliant authors like Peter Turchin. They'll tell you right now, one of the preconditions for war is inequality. And I'm telling you, if we're right on this jobless recovery theme, even a little bit more than we currently have been, we're going to wind up in some sort of conflict, most likely as a function of this. I hope not, but again, that would be hoping not would be fighting centuries of data, and we're not. That's not what I do. I get paid to do.
Yeah, and the proponents of AI, when asked this, will say, well, if it gets there, there'll be UBI and that'll solve everything. I've got strong skepticism around that, and that's probably a hairball to talk more about.
UBI comes after the problem, though. The people, even if they get UBI, they're gonna get. We're only going to get UBI after a bunch of the unemployment rate goes up a lot. UBI is not going to come before the unemployment rate goes up a lot. There will be a tremendous amount of hardship in these economies, particularly economies that adopt AI the fastest with the least amount of guardrails. There's going to be a tremendous amount of hardship for a lot of families. So part of my job as CEO of 42 Macro obviously is to guide the global investor communities and their portfolios to navigate this all these dynamics safely and help them maximize upside capture in bull markets and minimize downside capture in bear markets. But again, as someone who escaped the very bottom of this K, I have a duty, I have an obligation as a Christian to warn people about what could potentially happen in the future. Again, I'm not a doomsdayer. I'm obviously bullish. This is not a doomsday quote, but I think we have an obligation to try to make the world a better place. Or certainly, I believe I do as a Christian. And we're going to use our research to try to educate the general public, not just the investing public, but the politicians and the other key decision makers in society on how to potentially avoid some of these really left-tailed type outcomes.
Well, that's one of the many reasons why I'm such a huge fan of you, Darius. But as I see making it, bringing it down to kind of thoughtful money viewers watching your material here and the partnership that we just announced between our businesses here is, I think a big important part of what you're doing is telling people, hey, look, there is opportunity in this trajectory that's out here. It's all the things you're bullish about. And you're trying to get as many people to, be able to take care of themselves and profit from this so that as sadly, the bottom half of the K may continue to struggle from here, they'll be in a position to actually help others.
Amen. Amen. What's one of my favorite things I've ever heard said in the history of mankind is Jay-Z, arguably our most successful American. He's probably the most successful person in this whole American experiment thing that we've ever seen. The only person in the history of mankind that was a crack baby that became a billionaire. So in terms of being the American dream, this man said, I can't help the poor if I'm one of them. So I got rich and gave back to me. That's a win-win. That's something I live my life by.
All right. Well, look, we'll end the AI part there, the AI jobs part there. But again, I would love to have a deep dive on this at some point in the future with you if you are so inclined and available. Let's get to the KISS part before we wrap things up.
Oh, yeah. We obviously do a tremendous amount of fundamental research. This is a 170 slide deck. We publish one of these presentations every month with the webcast to our global investor community. And obviously they love it. But I'll tell you right now, the best investors in the world rarely make changes in their portfolio in response to fundamental information. The best investors in the world, the folks with the best performance across the global buy side, the folks that charge the most money for their investment services across the global buy side, the funds that charge 3 and 30 across the global buy side, most of the portfolio repositioning decisions that they make are functions of institutional risk management overlays. And so as someone who's helped design and implement those risk management overlays for the global buy side for many years, it became very clear to me that there's a big opportunity for us to build something that narrows that performance asymmetry between these funds in terms of their ability to reduce volatility drag and maximize upside capture and ultimately grow their portfolios, their wealth faster, their clients' wealth faster than the general investing public, and that's only done by eliminating volatility drag. And so we built this KISS system to essentially import two of what we consider to be the hallmarks of institutional grade risk management to the general investing public. The funds that charge 3 and 30 for their services across the global buy side, they employ a combination of volatility targeting and dynamic position sizing to manage risk for their investors. And we do this very simply. We built this very simple system that helps, is very simple to follow in terms of participating in. We use our risk management processes, namely our market regime nowcasting process, which incorporates the vol targeting, and then we use our volatility adjustment momentum setting, which incorporates the dynamic position sizing. We just apply that instead of applying it across dozens or hundreds of PMs across dozens of asset classes. We just simplify it. And so KISS is just a very simple 60-30-10 trend following strategy that is designed to demonstrably outperform what everybody's favorite quote unquote retirement solution is, which is 60-40. The 60% stocks offensively expose our portfolio to productivity growth. We use VT global equities for that, so total international equity market, including the US. We use gold, 30% gold, which defensively protects our portfolio from financial repression. We talked about this in recent episodes, Adam, but going back to October of 2024, we developed our bullish bias on gold in September of 2023 when we first outlined our investing during the forward turning regime analysis, and ultimately first noticed the geopolitically driven supply demand imbalance in the Treasury securities market. It took us until October of 2024 to finally have enough conviction and confidence to make the change in KISS to swap out core fixed income, the 30% target allocation to core fixed income with gold. Obviously, that was a phenomenal decision that we made, but I mean, it took it took almost a year of soul searching. Don't forget, we have some of the world's largest fixed income portfolio managers as clients. I can't go to a meeting with them and say, hey, we don't have any allocation of fixed income. That took a while, but again, it was the right call. And and after many sleepless nights, we finally made the decision to do that in October of 2024 and haven't looked back. And then finally, the 10% target allocation of Bitcoin defensively protects our portfolio from monetary debasement. And so, if you're implementing KISS, what this essentially looks like is just a pie chart asset allocation. It's very simple to implement. You only have to, implement the pie chart at any given time. We're currently at 10% cash because there's no position in Bitcoin. Bitcoin we've been out of since November 7th. Our risk management overlays, the top down and bottom risk management overlays that incorporate the vol targeting and the net position sizing, got us out of Bitcoin on November 7th. I want to say Bitcoin is probably down 30 to 35%.
Yeah, wow. Okay, that's good timing.
Yeah, absolutely. And again, that's not a fundamental research call. Those are the risk management overlays telling us that there's left tail risk developing in this asset class and we need to reduce our exposure. That's what vol targeting and net position sizing do. And so we're still at 100% of our maximum exposure in equities and VT global equities, total international equity market. We're still at 100% of our maximum exposure of 30% in gold. And so ultimately, as someone following this KISS system, again, just implementing this simple pie chart across three core asset classes, stocks, gold, Bitcoin, and then there's cash whenever it's not maxed out. If you're just implementing this very simple system with 3 different ETFs, or you can swap out ETFs, we allow folks to do that if they want to customize it. But this standard version of KISS is incredibly effective, Adam. Incredibly effective. I mean, so effective that we have thousands of investors around the world consistently telling us that they're having the best performance they've ever had. They've reduced the amount of time that they spend going down research rabbit holes. And as a function of having the best performance and reducing the amount of time, their stress levels are way lower. They're interacting with their family and their community better. They're supporting their family and communities better. It's such a positive thing that we built here in terms of this KISS model portfolio system. And so if I can end on this, a couple highlights from this, rolling out a sample back test that we produced. Just a few things to highlight on in terms of the drawdown. So KISS, the max drawdown for KISS is minus 12% on a rolling out of sample basis. That compares very favorably to the max drawdown of 23% for the 60-40 portfolio and the max drawdown of 28% for a naked long, fully invested portfolio, 60% global equities, VT, 30% gold, and 10% Bitcoin. So if you were just always long those assets in those ratios without our risk management overlays that incorporate the vol targeting and the position sizing, you would have the max drawdown of 28%, as opposed to a max drawdown of only 12% if you actually, if you use our overlays. And so the five most important numbers on this slide, I would say, are the numbers that I'm circling now. And so if you wanted to compare KISS to 60-40 portfolio, it has an upside capture ratio relative to 60-40 rather, of 300% and a downside capture ratio of 54%. So you're essentially getting 3 times the upside and only half the downside relative to 60-40. If you wanted to compare KISS to a naked long portfolio of 60-30-10 stocks, gold, Bitcoin without our risk management overlays, you would have 97% of the upside, but only 45% of the downside. So what you're doing here is you're creating a positively skewed return distribution in your portfolio, which allows you to compound returns from a higher net asset value across multiple market cycles. Notice I said from a higher net asset value.
Yeah.
Exponential growth works better when you compound from a higher net asset value, which is something you can only do with the positively skewed return distribution, which is what KISS creates for our customers. And so the final thing I'll say, and as I mentioned, the fifth number that's most important on this page is the CalMAR ratio, which is the compound annual growth rate of the strategy on a rolling out of sample basis divided by the max drawdown of the strategy. The CalMAR ratio for KISS of 1.3 is exceptional. I mean, it's very difficult for anybody to achieve a CalMAR ratio of 1 in institutional finance. And so we've built a system that allows us to have a CalMAR ratio that's even greater than what would be considered exceptional across institutional finance. And that CalMAR ratio compares extremely favorably to 60-40 at 0.3 and a naked loan portfolio of 60-30-10 stocks, gold, Bitcoin of 0.7. So super proud of what we built, even prouder of the incredibly positive impact that we're having for thousands of investors around the world. And just really grateful for the opportunity to present today. And more importantly, Adam, super proud and really grateful for the opportunity to partner with you, brother. This is going to be a phenomenal journey.
Thank you. Well, look, thank you again for everything, but for today, for going through again all of your work in such great detail. A couple quick questions there on KISS. One is for folks that didn't catch the ETFs that you're using for KISS. If you subscribe to the service, they're all right there. Darius will share them right now. But the equity one is a global equity one. So you're very excited now about the prospects for international equities versus domestic equities. You're capturing that in this global ETF, correct?
Yes, correct. And then this is total international equities, which includes the U.S. as well.
Right. It's the whole world, more or less, right?
Yeah. So it's the whole world's equity market. And so one of the things that gets us very excited about the durability of this convergence theme that we started the conversation with today is the fact that if you look at these global equity ETFs, VT is the one we selected for KISS, has the best combination of geographic exposure, liquidity, and expense ratio of the ETFs that we sampled. A couple other ETFs that we sampled, I think SPGM, I believe, is the global equity from State Street, from Spiders, and then ACWI is the global equity ETF from BlackRock, from the iShares. And all three of them, Adam, have 60% allocations to U.S. stocks. All three of them. Mm-hmm. Now, that, in my opinion, I think that almost guarantees that we're going to be right on this long-term convergence thing. And the reason I say that is, if you look at the actual market cap of global stocks, of U.S. stocks relative to global stocks, we're only 46% U.S. So investor portfolios have 60% U.S. stocks in them, whereas U.S. stocks are only 46% of the total.
Right, they're overweight U.S.
They're overweight U.S. Every investor in the world is overweight U.S. at a time where we're likely to experience for the next several years a convergence in productivity, profitability, earnings, and valuation in international stocks. And so ultimately, as an investor, you just have, in our opinion, you have to diversify. And I'll end on this, and I don't want to end with a scary thought, but this is a scary thought. Every CapEx bubble in the history of the modern U.S. economy, going back to 1800, has ended in a secular bear market. Now, we can debate whether or not we're in an AI CapEx bubble or not, but if you believe that we are in an AI CapEx bubble, you have to assume that it's going to end in a secular bear market for U.S. stocks. And so if that's true, then obviously you're going to want to have some diversification, if not a lot of diversification, in international stocks. And so we think VT positions KISS and the members of our global investor community really favorably for that outcome. One, to capture the upside of the convergence trade, but also to minimize downside capture when this thing finally does roll over, if we're right on this AI capex bubble equals subsequent secular bear market. I mean, you go back to the panic of 1857 and 1873 after the railroad capex bubbles led to secular bear markets of 54 and 35% drawdowns, respectively. The consumer durable goods capex bubble in the 1920s, kick-started a secular bear market that featured a max drawdown in S&P terms of minus 86%. And then the IT capex bubble from the 90s concluded with the secular bear market in U.S. stocks featuring a max drawdown of 49% for the S&P and 83% for the NASDAQ. I mean, if we're even half right that AI capex bubble will end in a secular bear market, then you just wouldn't be a good fiduciary of your own or someone else's capital to be still overweight U.S. equities in that context. And so ultimately, going back to this previous chart here, we just think that 60 in the investor portfolio, that 60% overweighting is going to go down and down and down over time. And so I think we're right on this.
All right. So one of the really attractive things about the KISS model is not just the performance, which you just walked us through, as well as the lower, shallower corrections versus the other type of approaches. But it doesn't change all that often. I mean, it does change, but like there's a lot of people who subscribe to someone else's market newsletter, and they may be making trades every week, a couple times during the week. Like you,
a couple times a day.
Pardon me?
I've worked at a place that was sending out trade updates several times a day.
Several times a day, right? Yeah. So with KISS, and of course it differs given what's going on in the market, but kind of like how many times did the KISS model change in 2025?
Probably less than 10.
So
in terms of so this rolling out a sample back test begins in January 2018. Since January 2018 and this rolling out a sample back test, there's only been an average of 2 trades per month in KISS, but they're clustered. So whenever we have a market event, the KISS takes down risk in a series of successive trades, and then once we come out of the market, market crash, then KISS will take up risk in a series of successive trades. But then it could stay there and not do anything for several months, if not a few quarters. It's not like KISS is trading twice every single month. It might trade 6 times to take the risk from 100% allocated to 0% allocated, and they might trade 6 to 12 times to take it back up to to fully allocated. So it's
and then it might sit there for months with no trade, no
quarters. Yeah, totally, 100%. Yeah, very easy. But I mean, from the time, I think from June 2nd to October 30th, there were no trades in KISS from June 2nd to October 30th. I think when we started taking down Bitcoin of last year. So KISS was just fully invested, just maximizing upside capture like it's supposed to do from June 2nd to October 30th. KISS started buying S&P and Bitcoin, stocks and Bitcoin back in November or back in April when we pivoted to Paradigm C. But again, that was coincidence, not on purpose. When we pivoted to Paradigm C, that's a fundamental research call that we made at the time that was subsequently confirmed by our systematic process that said, hey, now this is the right time to actually put that on. And I'll leave you guys with this piece of investing wisdom. The best investors in the world do not, like I said earlier, they rarely make changes in their portfolio that are fundamentally oriented. They, generally speaking, wait for some sort of confirmation from financial markets to prove of their fundamental research views. A lot of investors, the general investing public does the exact opposite. They learn about something and they go, well, the moment I learn this, and suddenly it's a good idea, now I got to put the position in my portfolio. The moment I figured out that this is a short or a bad idea, I got to short the thing. That's not how the world works. That's certainly not how institutional investors maximize upside capture in bull markets and minimize downside capture in bear markets for their customers. They are much more tied to the decision. They systematize the decisions that they make in their portfolios with the use of institutional grade risk management overlays, the kind that we feature here in this KISS model portfolio that produce such stellar results, both on a back-tested basis, rolling out a sample back-tested basis. But this thing has been live since January 2023. I'll invite everyone who's still listening to us talk right now to go check out the 42 Macro testimonials page, 42macro.com/testimonials. There's hundreds of testimonials from investors just like the folks who are listening to me talk right now, saying a few things. KISS has produced the best returns they've ever had in their life. They're feeling confident about their retirement for the first time they've ever been as investors. They have way more time that they're spending, way more time they're spending with their family because they're not going down, rabbit holes on this fundamental theme or that fundamental theme. And ultimately, as a function of those three things, their stress levels and their health, the stress levels are lower and their health is better. I mean, hundreds of testimonials on that page from investors all around the world, 80 plus countries around the world. So I know that we built something really special here, and I'm really grateful to partner with you on this journey, Adam.
No, thank you. So I just want to make one thing really clear here. Actually, a couple of things real clear as we wrap up. Um, you you use the term systematic. I just want to let folks know if they haven't watched our previous videos here, that KISS does what your model tells it to do. It doesn't do what Darius Dale might think when he wakes up in the morning, right? So this is very much a process driven model here, correct?
100%. Absolutely.
Yeah. So, of course, one of the benefits of working with a solution like this is it is systematic. It bleeds all the emotion out of it. You are leveraging the discipline that Darius and the 42 Macro team have and have put together to build this model here. I've talked many, many times in the past with other experts, Darius, about how, talk about behavioral and economics, and oftentimes we are our worst enemy when it comes to our investing success going forward, because we're just human mammals and we make a lot of emotional driven decisions.
Exactly.
But the thing I want to underscore is, if you do subscribe to the 42 macro service and you deploy it, as an individual investor, you're not signing up for this, oh my God, I've got to read this thing in full every day because I've got to make trades every day or several times a day or whatever. It's a very manageable process for you
Very
to
slow.
follow because it doesn't have that many changes.
Very infrequently. Again, the only time the changes cluster when the volatility clusters, which is another core finding that powers the volatility adjusted momentum signal element, which powers both the market regime nowcasting process, which we feature in the top down risk management overlay, as well as the bottom up risk management overlay, the dynamic position sizing that we feature in the bottom up risk management overlay. The trades cluster. So if we're heading into a market crash, then KISS in a successive series of trades will take down stocks, will take down Bitcoin, maybe even keep gold where it is. It certainly kept gold where it was last year. And then when you're coming out of the market crash, crystals in a successive series of trades take up, the risk to stocks, take up the risk to Bitcoin. And so that's where the trades get clustered. And by and large, there's hardly any pivots. There's hardly any pivots. I
All
mean,
right.
yeah.
So, folks, rubber meets the road here. If this is something that you're interested in learning more about, go to thoughtfulmoney.com/DIY. It's a very short form you fill out there. It'll literally take, I think it asks for your email address, your first name, last name. You get connected with the 42 Macro team, and they will provide any and all information that you might need to make your decision. And obviously, Darius, super duper excited about this. Real honor, privilege, nothing but optimism about what lies ahead here. You are also going to be a featured speaker, as you have been in past ones, at the upcoming Thoughtful Money Spring Conference, which by the time this video releases, I think will be just 3 weeks away. One, I want to thank you again for coming and participating in that. There's a couple of topics we didn't get a chance to talk about here. There's also the potential that there might be a change in the KISS model between now and then. And folks will to find out, tune in and watch Darius at the conference itself. But can't thank you enough. And Darius, if you don't mind, I'm just going to mention some of the co-speakers there with you because I think we have just a ferociously amazing faculty this year. We got Lacey Hunt, who kicks it off every year with a keynote, but he's coming back to do work his magic there, give his graduate level chart presentations. We're going to have first timers Ed Dowd, Michael Oliver, and journalist Matt Taibbi. We're going to have Judy Shelton. She'll be interviewed by Danielle DiMartino Booth. We're going to have Michael Howell, the liquidity expert. We're going to have Stephanie Pomboy. We're going to have Grant Williams. We're going to have Luke Groman. We're going to have Brent Johnson. We're going to have Rick Rule. We're going to have Melody Wright. We're going to have Andy Schechtman. We're going to have David Hay. I feel like there's another combo that I'm leaving out there. Obviously, we got the amazing Darius Dale, who's going to be there, but really just kind of a murderer's row or, Chicago's Bulls lineup here, whatever amazing lineup you can think of in your mind. And I think the timeliness is going to be really, really important. And as you've talked about, Darius, there's I think a lot of octane ahead for some of these trends for the people that position themselves in them early enough. So again, folks, if you're interested in this, come to thoughtfulmoney.com/conference to buy your ticket. And actually, like I said, it's only 3 weeks away, but there's, I think now less than a week to get in at the the lowest early bird price discount that we're offering. And I want to make sure everybody possible gets that lowest price. So go sign up now and get it while you still can. And a reminder, if you are a premium subscriber to our Substack, I've emailed you a code you can use to get an additional $50 off of that low early bird price. And just as a reminder, the conference itself is on Saturday, March 21st. And don't worry if you can't watch live. Everybody who buys a ticket will get sent replay videos of the entire event within just a few hours of its conclusion. So with all that said, Darius, I can't thank you enough, my friend. Again, so excited about this partnership. Any parting bits of counsel or last words to the audience before you come back on in a couple of weeks for the conference?
Yeah, one, I'm excited for this conference. I mean, wow, what a
Oh, well, thanks.
lineup.
Well, look, dude, you're at the top of that
Unbelievable.
pyramid.
No, look, I don't know at the top of the pyramid, but I'm grateful to contribute. I will say this: if you're an investor who DIY, you like to pick factors, because obviously KISS is designed to be boring. The
Hmm.
whole purpose of KISS is to maximize upside capture in bull markets and minimize downside capture in bear markets. If you do that over and over for enough market cycles, you're guaranteed to retire on time and comfortably, which is the core feature of what we've built here at 42 Macro. If you're a DIY investor that does like a little bit more action, that wants to, go across factors, sectors, pockets of fixed income, pockets of global equities, or crypto commodities, we actually make, we run our Dr. Mo system, which is basically KISS, but for 70 different factors across U.S. equities, U.S. equity factors, sectors, global equities, fixed income sectors, and macro exposures to essentially get you to the right asset allocation across each of these individual factors. And the reason I bring this up is because, going back to your conference, Adam, you have so many really thoughtful investors in that conference that it almost behooves, like it's getting to the point where it's like milking or something. You can't not participate as an investor. I'm serious, because the people on, if you're taking factor risk in global financial markets, which means you are now in the alpha game, not the beta game, which
Yeah.
institutional investors must be in. Retail investors have a huge competitive advantage in being able to capture beta and actually get rewarded for beta in financial markets. But us institutional investors, we cannot. If you're in the alpha game, once you decide you're in the alpha game by deciding to take factor risk across all these different factors, across these different asset classes, then you have to recognize that alpha is a zero sum game. Beta, a rising tide can lift all boats. Alpha is a zero sum game. So it behooves you to be as wise or wiser than the people on the other side of your trades, the machines on the other side of your trades. And so, going back to your conference, Adam, I just don't know that investors at this point can afford to miss it, because that's too much
Yeah.
information. That's too much insight.
Well, you're so kind on that. And I'm so glad that you mentioned that. So, folks, KISS is sort of where the 42 macro service starts, and then there's additional ways to get additional insights, more complex ways to trade if that's what you want to do as an individual investor. And Darius did a great job of just giving you the tiniest of peeks into that. But of course, all that information is available over at thoughtfulmoney.com/DIY. So definitely go there. So just in saying goodbye here, Darius, I got to just quickly note, you are looking very svelte, my friend. And
Thank you.
before we turned on the camera here, you were sharing me a little bit of your journey. And look, I thought you were one of the most handsome guys that I interviewed, period. But you've dropped, how much have you dropped in the past, say, 6 months?
Uh, I think when I started rucking, which was that a year ago or 18 months ago?
Okay. Yeah,
I
from
think
whenever you put the pack on.
I was probably 295. I played left tackle at Yale, so I'm a former offensive lineman. I was probably 295. I'm probably about 265 now, so I probably lost 30 pounds just rucking. And you're the reason I started rucking. You sharing your fitness journey and all the benefits of rucking for you. I started trying it out, and 30 pounds later, I'm feeling in some of the best shape of my adult life. I'm feeling very healthy, man. So thank you.
Well, that's such an honor to hear. And look, kudos all goes to you, my friend, none to me. But I mean, I've met you in person, and I mean, you're a big guy. I mean, you're sizable, but you look great in general.
Yeah.
I can only imagine just sort of how trim and muscular you got to be now, given everything that you've been doing. But again, I wanted just to end on that because I think, well, I know from talking to you like me, we want people to get financially resilient and then financially prosperous for all the reasons that we mentioned. But we keep in mind that, at the end of the day, the money, it's just a means. It's not the end in and of itself. And the things that really matter, friends, family, meaning in life, good health, and whatever, those are the really important things to make sure you don't forget to invest in along the way.
Amen. Spiritual health, physical health, financial health. Spiritual health, number one. Physical health, number two. Financial health, number three. If you can fix those things in that order, you're going to live a phenomenal life. And I'm really blessed that, I'm someone who's lived a very, very bad life, very, very poor and hard life, a lot of hardship. I've experienced a lot of hardship in my life. I'm really blessed to be on this side of it. And I'm really blessed, more blessed to be, helping uplift a lot of people to bring them to this side of it. Cause it's pretty nice.
Well, my friend, you've just done a great job of displaying why I have been such a huge fan of yours for so long, but also why I made the choice to partner with you and your company. And I just want to say, Darius, I really do hope that in a future video here, we can spend some real time going through again, kind of your whole origin story. I think we might have talked about it once or twice in the past year, but I'm sure there are a lot of viewers here that haven't heard it. And I think it's a really important one for them to hear, because you come from, your very humble origins and have had faced a lot of adversity from birth in your life, but overcome it. And not only overcome it, but jujitsu that adversity into outperformance and prospering, not just for yourself, but for everybody that you can touch and help influence. And my friend, I think you really do, better than almost anybody I know, sort of personify the old saying that it's, we can't control what happens to us, but we can control how we respond to that. And I think your personal story is just such an inspiring version of that. So anyways, my friend, I hope we can get that, kind of a recap of that whole origin story into one of your next appearances on here. But that being said, my friend, I can't thank you enough again for doing everything that you normally do, just given such a generous walkthrough, really, a torrent of insight and very actionable guidance there for folks that you've laid out for us here in this interview. Again, I can't thank you enough for coming and participating in my conference as well, and very excited at what the future holds for both of us with this new partnership. But yeah, my friend, thank you so much, and can't wait for all that we'll do together in the future.
Thank you so much, Adam. It was wonderful to be here with you and your audience, and I'll see you at the conference in a couple of weeks, man. Cheers.
All right. Sounds wonderful, my friend. Thanks so much. Everybody else, thanks so much for watching.
So you're seeing retail catching the wave, which is driven by governments buying gold, right? So they have to get out of the way of the price. The price is running. Now silver's running. So that is what's going on. The question is, where's it going? And when I look, when is the situation with America, which is effectively saying it's on the warpath?
Right.
China's saying, we're just growing, we get bigger and more powerful. We've got 4 times more people than you, and give us 10 years, we'll have as much money. So we'll have 4 times as much money as you. We're the superpower now. And America's going, hold on a minute. No, we're in charge here. And stop that. Stop that getting richer at our expense. No, we see you now. We know what you're doing. You're going to stop that.
Retail investors are now riding the momentum in silver, fueled by governments accumulating gold and pushing prices higher. With the market moving fast, the real question is where it's headed next. On the global stage, the US is signaling aggression as it seeks to maintain dominance, while China, with its massive population and rapid economic growth, is positioning itself to rival America within the next decade. The US sees this rise as a threat and is determined to halt China's advance, setting the stage for escalating tensions that are further driving demand for precious metals. Clem Chambers is a well-known financial commentator, author, and entrepreneur. He highlights that gold is surging because governments view it as the currency of war, a hard asset essential for defense and global power, beyond the reach of paper money or manipulation. With the US and China in open rivalry, central banks, especially China's, are buying heavily, driving prices higher. Silver, on the other hand, has always been everyday money. So as gold becomes too expensive, retail investors are piling into silver as the affordable alternative. Together, this creates a chain reaction where governments fuel gold, retail fuels silver, and institutions can't stop the momentum. For additional information, view the video. Please subscribe and like the material if you enjoy it, to receive the latest updates.
Well, hold on a minute. Gold's a bit expensive now. What? $3,500 an ounce? That tiny little fleck of gold. And silver, I can buy a sack of it. I can buy a load of old quarters from 1935. And by the way, if the world did end, I can go to my neighbor and say, see that chicken? I've got a silver quarter for you. I'll buy it. You can't do it with gold coin, can you? So anyway, the old currencies apply. But silver, see, gold back in the day was not money, it was currency. You have a few gold coins, you put them under the floorboards. It's not everyday money. You don't walk around with it. Now, if you think about gold, silver, copper, gold is for your cash, your wealth, or whatever counted for banking. Actually put it in a bank, literally, bury it underground in the corner of your house. That's how they used to do it. Silver, now that is purse money, that's wallet money. You carry that in a little sack which you tie to your pants. Okay, right. So you don't really lose it because it's in a purse. You might bury the purse if you're having a problem. It might split. It might all fall out. That would be a pain. But you put the copper in your pocket. That is pocket money. So you've got pot money, purse money, and you've got pocket money, right? Which is why if you go treasure hunting, you will find infinite quantities of copper because it was in the pocket and easily lost.
Right.
Yeah. So that is a hierarchy of metals. Yeah. So gold is for cashing. Silver is for high-ish value transactions. Yeah. So that's why it's retail. That's another reason it's retail. So anyway, a retail looks in and goes, look at that gold go. Oh, I'll buy silver. And that's what you're seeing now.
Right.
So you're seeing retail catching the wave. Yeah. Which is driven by governments buying gold. In the old days, your investment banks would go, hey, gold's going on a run. We're short that. We're short that. We're short that. Oh, yeah. We manipulate the price. And retail will go, oh, no, I'm losing money. I'll sell. Oh, I'll take it back. I'll take it back. And you can, and the institutions can do that with retail because retail is, there's always the frothy part of retail that is easily manipulated. But they can't do that to government. That's playing, that's wrestling Godzilla. You are going to lose. Right. So they have to get out of the way of the price. The price is running. Now silver's running. Yeah. So that is what's going on. The question is, where's it going? And when I look, when is the situation with America, which is effectively saying it's on the warpath?
Right.
Yeah. China's saying, yeah, we're just growing. We're growing. We get bigger and more powerful. We've got 4 times more people than you. And give us 10 years. We'll have as much money. So we'll have 4 times as much money as you. We're the superpower now. And America's going, hold on a minute. No, we're in charge here, and stop that. Stop that getting richer at our expense. No, we see you now. We know what you're doing. You're going to stop that. Well,
Clem Chambers demonstrates that China under Xi has shifted from cooperation to confrontation, reviving Maoist ideas, discouraging Western influence, and asserting power over Taiwan. This has fractured global supply chains, turning critical resources like rare earths and cobalt into weapons of leverage. The U.S. is responding by rearming and rebuilding industries like shipbuilding, which are essential for military strength. Strategic reserves of gold, silver, and critical materials are becoming vital as global trade routes grow more fragile and politicized. Clem emphasizes that this dynamic is reshaping geopolitics. America is pressuring Europe to rearm while also courting India to counterbalance China. Russia, though armed with nuclear weapons, lacks the economic weight to compete. China, however, is a true rival, with far more financial resources and technological capacity. The global stage is being redrawn into blocks, and for ordinary people and markets, the consequences mean heightened risks, disrupted trade, and the urgent need to secure assets in times of escalating conflict. Let's redirect our attention towards the interview.
Xi came in to China and brought back Maoism, which is not good. He said to these children, stop playing computer games, start getting fit, stop learning English, hey, Taiwan, we're coming for you.
Right.
Well, that's what kind of started the ball rolling. Yeah. Now, their predecessors were much more, yeah, we'll be your friends. We'll make your plastic junk. We'll make money, and we'll all be very civilized and nice. And, we can all be friends. But Zaya has taken a China exceptionalist point of view in the same way as America takes an American exceptionalist point of view. And in
Right.
fact, the world needs to be more like the Europeans who, up until recently, have been quite laid back. Yeah, we can get on with you. Yeah, build a pipeline. Yeah, let's all do business. Yeah, let's all be friends. Well, that polarity means that all these global supply chains are now fractured. Yeah.
Right.
So you can't actually rely on your cobalt flow anymore, or your rare earths anymore. And that's the base of your economic pyramid. And whereas before they were commodities and they just got loaded up to ships and sent to wherever they needed to be, and everybody was, relatively reasonable with each other. Now it's like, oh no, you can't have the rare earth. No, no, no. We've weaponized it. No, no. See how far you're going to get with your business without our rare earth. Oh,
Right.
cobalt. No, no, no. So now countries basically have to build up strategic reserves of all sorts of critical things. And
Right.
silver is good. You start by going, oh, the only thing we need is gold, because gold, that's bullets, and we can buy everything we want with gold. And then you go, actually, maybe we can't. Maybe we won't be able to buy it all. Maybe we won't, if they're shipping it, and they say, no, if the ship goes there, we're going to sink it. I mean, what's been going on with the Houthis? They've been firing at ships. The thing that happened also that is, I had to check up to see whether it happened, and it actually happened. Trump came out and said, if you've got a Chinese ship and you land containers, we're going to bill you. We're going to bill you 2% of the value of those containers when you
Wow.
land. So if you're a container ship built in China, that's a $7 million bill just to pull up at the port.
Wow.
Yeah. And that's so that people buy American ships, not that America makes many ships just yet, so that the ship industry in America will take off again. And why do they want shipbuilding in America? Well, if you can't build ships, you can't build battleships, can you?
Mm.
Yeah, you can't build all those Liberty ships that were built in the Second World War to ferry all that important equipment around the world as you're fighting World War III. Oh,
Right.
oops, I can't build ships. Oh, well, actually, maybe we'll build a few shipbuilding. Oh, I can't build ships because I haven't got any iron. Oh, still. No, and I haven't got any I've got no
Yeah.
rare earths. I can't build any planes. Yeah. So that is what's driving all of this. It's basically America rearming.
Wow.
And yeah, exactly. And it's not good. It's like, okay, you could say they have to, they need to, they must. Okay, I'm not going to argue with that. But what that actually means in reality to people like us and to the markets and to the world economy and what is the denouement on that? Normally, these things don't suddenly heal themselves and everyone's friends. That is dramatic, absolutely dramatic. And that drumbeat, I mean, when they had that speech in Europe, it was like, oh no. And then you go, well, I'm just being paranoid. I'm old and I'm paranoid. Oh no, they've done something else. And every dot on the map, it only makes sense when you see it as America rearming.
Right.
And they've told Europe to rearm, and Europe is rearming. Well, that's not good. I mean, okay, forget it. Maybe it's great. I mean, maybe I'll be, old enough I won't care that there's World War III started. But maybe I'll make so much money I'll be in Chile and drinking red wine, crying, but I'll be far away. But nonetheless, it's not. I can't change that. The only thing I can do is look at it and see where there's real returns to be made to
Right.
secure myself and my family. And that's how I look at it. It's, I can't, maybe it's necessary to have World War III. It's nothing to do with me. I can't affect that in any shape or form. But there you are. There is that drumbeat. And they might stop. After all, somebody wants a Nobel Prize. Maybe China is too fragile to get into this Cold War conflict. Maybe it's, Russia versus America all over again. Maybe it
Right.
isn't. Whatever. But if you don't realize what appears to be going on, you don't track it, and you don't. I mean, something that is. I was relieved a few weeks ago. Trump was getting angry at India, at Modi.
Yeah, I heard about that.
Yeah, but you realize the moment America starts sucking up to India, that is very, very bad, because in a global conflict, it's China, India, Russia, and America and Europe, right? India is a major player. Now they historically go, nothing to do with us. No, nothing to do with us.
Right.
Nothing to do with us. But if America is really accelerating, it has to make India either neutral or their friend. Because then it's China and Russia. Well, Russia's nothing. Everybody's worried about Russia. Russia's 150 million people with no money. Right? China is 1 billion with all the tech that we love. I mean,
Wow.
forget Russia.
Yeah.
Russia is, not a thing really. I mean, it can nuke everybody. That's the thing it's got. But you take away its nuclear, what has it got? It's got no money. It's got hardly anybody. Yeah, 150 million people versus 500 million people, $7 million GDP versus a $35,000 GDP per head. It's like
Wow.
1/18 of the economic power of Europe,
Yeah, it's a
without
big
even
difference.
factoring America in there.
Yeah.
But China's a different matter. China's got more money, literally more cash. In dollar terms, it has got twice as much cash in dollar terms in America.
Wow.
So if you counted up, if you stacked up all its yuan, and you said that's that much of dollars, and you stacked up all the American dollars in existence out there in circulation, it's got twice as much. Yeah, you fly into Shanghai at the airport, and you fly into JFK, and you think, JFK versus Shanghai Airport in a battle. There's only one winner there.
In short, the world is entering a new era where gold and silver are not just investments but lifelines in a fractured global order. As nations rearm and tensions rise, precious metals are gaining renewed importance both for governments seeking power and individuals seeking protection. The momentum in these markets reflects not just financial trends but deep geopolitical shifts that will shape the decade ahead. How long can central bank demand continue driving gold and silver higher before retail investors face a major correction? Could rising geopolitical tensions accelerate a shift toward a new monetary system backed by precious metals? We'd love to hear your thoughts, so share your comments below. Don't forget to subscribe for more content and hit the like button if you found this video valuable. Thanks for being part of this journey with us.
In the bust, most assets are going to go down other than treasuries. But so gold will correct. If 4,000 were the high, and it may not be, could just as easily be 4,500, but if 4,000 is a high, you could be back to 3,000 or below in the bust. People want a target in the bust. I go, we don't even know what the high is on the way up. So, but it'll get hit by, 30% or more probably. Silver, if my target on silver is 75, if we correct from 75, that is more volatile, so that could go down, back into the below 30 or back into the 20s. So they're not going to be straight lines. In both cases, I think this is important. In both cases, in the post-bust era, which is 2027 and beyond, I believe you'll see gold probably in the early 2030s, and silver, same time frame. Gold to 20,000 and silver to 500. So
the outlook suggests that during a coming bust, nearly all assets except treasuries could fall sharply. If gold peaks around $4,000 to $4,500, it could correct by 30% or more, potentially dropping back near $3,000. But Goldman Sachs says gold could hit $5,000 under scenarios like political threats to Fed independence. Meanwhile, silver, being more volatile, might fall even harder. If it reaches $75, a correction could send it back below $30. These moves won't be in straight lines, but in the long run, especially from 2027 onward, the forecast is extremely bullish. Gold could reach $20,000 and silver around $500 by the early 2030s. David Hunter, a precious metal expert, points out that gold recently broke out of its consolidation range around $3,300 to $3,400, pushing to new highs, with targets now raised to $4,000 and possibly higher. Goldman Sachs warns that gold's price could increase dramatically if the Trump administration's attack on the independence of the U.S. Federal Reserve is successful. They say that would trigger a flight from traditional safe havens, assets people run to when markets get shaky, traditionally, the U.S. dollar. Forecast already predicts gold reaching $3,700 by the end of 2025 and $4,000 by mid-2026, the result of their expectation that central banks will continue their current gold buying spree. On the other hand, silver has been even stronger, up nearly 50% since April compared to gold's 21%. David mentions key drivers include a weaker dollar, falling interest rates, geopolitical tensions, and heavy central bank buying, all reinforced by strong momentum now attracting institutions. The dollar, down from 110 to 97, could drop further toward 82 in steep steps. With the Fed just beginning a rate-cutting cycle that could bring rates near zero over the next 18 months, both gold and silver still have significant room to run despite cautious sentiment in markets. As we start the video, don't forget to hit the bell icon and subscribe so you don't miss any updates. Please give us a thumbs up and leave a comment below if you enjoyed the article.
Absolutely, and I do say gold was in a consolidation from basically April till recently, and it broke out, from 3,300, 3,400, broke out here, and we're at new highs again. I raised my target to 4,000 last year, or not last year, I think a couple letters ago. I'm not going to be surprised if that proves to be low, more conservative. So I'm very bullish gold here. I'm even more bullish silver. Silver's had a great run. It's up. I just did the numbers yesterday. From April to now, gold is up 21%, I think, and silver's up 49%. So it's quietly, people haven't really noticed, but it's quietly outperforming gold as it does in a bull market. So I think silver has a long ways to go. Gold probably has a good ways to go too. So I think the weaker dollar is certainly part of that story. Lower interest rates is certainly part of that story. Global unrest and global uncertainty is certainly part of that story. And the central banks around the world gobbling up gold is certainly a piece of it too. So, and then the final piece, which people always underestimate, is the power of the momentum. It's all of a sudden the institutions are starting to notice gold, even though it's been running for years. Because it's got that momentum now, they're starting to say, hey, we have to have a piece of gold in our portfolios. Not low. I mean, the dollar's fallen from basically 110 to 97 in a matter of a year, probably, or less. And I think it's my target is 82. That's far below here. It'll happen in some pretty steep steps. So the first step down in the mid 90s, and then you consolidated here. I think the next step down takes you down through 90, and then the third step down to 82. So I'm not surprised at all. You have to go through consolidations when you have such a big decline. It then goes the other way for a little while. You have to convince some of the people that were jumping on the bandwagon, but not with conviction, that whoops, this thing's going the other way. So I think we've just pretty much gone through that consolidation, and now we're beginning the next leg down, and I think it could happen pretty fast. Well, think about that. I think that tells you the sentiment that's on the street. Everybody's got including yourself just there, everybody's got a foot out the door saying, when do I exit, right? And so what we've had here, we're just beginning an easing cycle. If the Fed is truly just beginning to cut, and that there's going to be many, many cuts between now and the end of next year, where you could see the Fed fund rate go from 4.25 here down to even zero. They don't know that yet. They have no idea that's what's coming. But if in the next 18 months, that's what you're looking at, and you're early on in that, and you're at a point where it doesn't look like the economy's falling out of bed, gold's got a ways to run. Silver's got a ways to run. The stock market's got a ways to run. And yet everybody's getting nervous here rather than bullish.
A few years ago, David called for a major market melt-up. and has steadily raised his targets as conditions improved. His S&P 500 target has climbed from 6,000 to 8,700, with Nasdaq at 30,000 and Dow at 60,000. He views this as the tail end of a long bull cycle that began in 1982, likely topping out soon, but still with strong upside left. Despite a slowing economy, falling interest rates and steady earnings are fueling gains. Interestingly, retail investors have stayed confident and bought dips, while institutions were more cautious and even bearish, only now starting to turn more aggressive as they see the market's momentum. Let's look back at the interview.
Probably 3 or 4 years ago, because I was calling for this melt up, and I get accused of raising my targets constantly. I go, that's what you do. As the evidence proves it's got more, there's more things saying it should go higher, you raise your target. So, I started out at 6,000, or even before that at 4,000, but I've raised it to, 7,000 and 7,500, then 8,000, now 8,700 on the S&P. And same thing, I've raised my gold target a few times. But it's the case that this thing is a big historic bull market. You just gotta stay with it. I'm sorry, I lost my train of thought of what you would. Oh, we were talking about the VIX. Several years ago, I said the VIX could go to 10, and that was when it was in the 20s. I said if we've got, and that was when I thought the market might go to 4,800, 5,000. I still would say that the low on the VIX, I think, is down just below 10. I think that's probably where we're headed again. So everybody gets worried when it gets down at 14, 15. I go, it can keep going, and there's no magic at 10. If it wants to go lower, it's really, it's a trading vehicle. There are times when it the market goes through a swoon and it bounces back up over 30 and maybe over 50. But other than that, I don't use it at all to say this is the top in the market, because it can go lower. We are, as I've been saying for a long time, I think we are late in a long cycle, a bull market cycle that started back in 1982. So this is the 43rd year as of August of a bull market cycle that I think is coming to an end. I expect to see, we probably could top out by the end of this year or sooner. But we've got, I raised targets back in April when we had Liberation Day and everybody got bearish. I raised my target to 8,000 on the S&P. From there, in my July investment letter, I raised my target to 8,700 on the S&P, 30,000 on the Nasdaq, 60,000 on the Dow, and the Russell 3,400. So I obviously think there's still a lot to go here, even though I think it's going to happen pretty fast. It is late in the game. We've had a long cycle. The economy is slowing. We may, in fact, already be in recession, but at this point, the evidence is not building to something that says I'm calling for a global bust next year, as you know. But the evidence right now allows most investors to see this as a soft landing, and earnings are still intact. So basically, you've got the best of both worlds: slowing economy, what I think are going to be declining interest rates, and earnings still growing. And that's music to the ears of Wall Street. That will get all the skepticism that's built up on Wall Street. They've fought this market since 2022, all the way up. You're starting to see them begin to say, "Hey, I gotta get more aggressive because this thing has legs." People, it's not that institutions go all in or all out. They're probably not very much in cash, but they're more defensively positioned. They have been skeptical towards the market. You're right. The retail investor, surprisingly, when we had that swoon back in April, they stayed in the market pretty much, and said this is a buying opportunity. It was the institutions that jumped on the bear market bandwagon and said, "Oh, we're going lower. We're going a lot lower." Strategists across Wall Street were lowering numbers and talking about 4,000 or 3,000 on the S&P. And it was surprising to see the retail investor stay basically on board and bought down there. Like I said, at the very bottom of the sell-off in April, I raised my targets while everybody else was lowering their targets. So, kudos to the retail investor that they this time were the smart money, and it was the institutions that weren't so smart.
Both gold and silver are showing powerful momentum, supported by central bank demand, a weakening dollar, and shifting global policies. While sharp corrections are possible if gold peaks around $4,000 to $4,500 and silver near $75, the long-term outlook remains extremely bullish, with forecasts of historic highs by the early 2030s. At the same time, equities may still have room to climb, even late in the cycle, as falling interest rates and resilient earnings continue to provide fuel. If a sharp correction does occur, would it present a buying opportunity for long-term investors or a warning sign of deeper risks? How much influence will central bank gold buying have in preventing deeper pullbacks in the years ahead? If you enjoyed the content, please like this video, subscribe to the channel, and press the bell icon for timely updates. We appreciate your support, and thank you for being with us, and wait for the next updates.
Silver's breaking out. It looks like 44 is kind of that next upside target. And I got a feeling like when you look at the monthly chart of silver right now with silver, where I think we could go all the way up and we could see it spike. And I think we could get up to that $49, $50 an ounce in silver. I think it could have a blow off phase and shoot higher. Very similar to, what happens near the end of a move is you get a very strong parabolic move. And so I think right now in the precious metal space, money is actually chasing the gold miners and the silver miners. Gold's taking a pause. Money's rotating out of gold because it just had a nice move. And we're seeing it move into like silver miners and gold miners. You can see they're extending and pushing higher. And we were long SILJ. We just hit a 20% target yesterday. We've actually closed that position out. I think now we might see, miners take a bit of a breather and a pause. And as money rotates out of miners with some profit taking, we flip back to gold, and gold has got this little pause that it's just had, and now gold will probably shoot up. So I think they're going to like piggyback on each other. That flows into miners and then flows into gold and goes back and forth.
With $44 as the next objective, silver is currently in a great setup for a breakout. It may reach as high as $49.50 an ounce in a traditional parabolic. The story is being driven by breakthrough technicals, tightening supply, and industrial demand. According to Investing Haven's forecasts, silver will first challenge all-time highs, reaching about $49 in 2025. Money is shifting right now. Investors are pursuing silver and gold miners who have been rising in value, and gold has just rebounded, so they are taking profits there. In order to prepare for the next step higher, miners may now pause as profits are taken. This money might then turn back into gold. Chris Vermeulen is a market strategist and technical analyst. He points out that silver is in a good position. According to a recent commodity forecast, bulls are aiming for $44 if resistance is broken, and silver is now trading close to $42. Although silver is more speculative than gold, both are expected to continue to rise as a result of this rotation. Silver is breaking out, according to technical breakout assessments, both in terms of its absolute price and in relation to stocks from 4-year bases. In certain technical models, medium-term targets of $49 to $50 are repeated. At the same time, gold's consistent increase serves as a warning to markets about anxiety around the world. While IT giants continue to drive U.S. stocks to near-high levels, internal weakness and exuberant sentiment point to the possibility of a significant correction in the near future. There are fissures in well-known industries, momentum and investor confidence are brittle, and valuations are high. Analysts warn that some profit-taking and sideways moves are typical following strong runs, in miners or metals. Although resistance has been breached by silver, further upside is contingent upon maintaining volumes and avoiding reversals. Chris believes when the cycle changes, investors need a strategy to identify trend reversals and safeguard their money. As we dive into the video, Don't forget to hit the bell icon and subscribe so you don't miss any updates.
Yeah, if we take a look at silver, we haven't traded silver just because gold, our play around silver was the silver miners. And so silver has done the very similar to gold as it's rallied up, and now silver's had a nice bull flag. It's paused. And so silver's breaking out and starting to run. So money's coming, I think, out of miners now and starting to go into silver. And then I think it'll bleed over into gold because silver is much more speculative than gold. So money's going to rotate probably from miners, silver, gold, and then kind of maybe loop around. These are very nuanced, small moves. But silver's breaking out. It looks like 44 is kind of that next upside target. And I got a feeling like when you look at the monthly chart of silver, we're in a sweet scenario right now with silver where I think we could go all the way up and we could see it spike. And I think we could get up to that $49, $50 an ounce in silver. I think it could have a blow off phase and shoot higher. Very similar to, what happens near the end of a move is you get a very strong parabolic move. You cannot trust a move that goes straight up because usually it comes straight back down. Very similar to what happened just before the last financial crisis. It shot straight up, came straight back down, and then sold off for 65%. So I think we have that potential for it to shoot higher still. And of course, that'll be good for silver miners as well. But yeah, right now we're in that sweet spot for precious metals. And you and I have touched on this cycle graph before. If we look at the stock market, this blue cycle here, precious metals really come to life near a major market top. And one of the reasons is people are moving away from, the stock market in general, and they're moving into physical assets, something where they won't lose value or won't blow up on them as much. And industrial capital goods are actually doing really well. When we look at the industrial space, businesses are still bullish, and industrial stocks are rocketing higher. Businesses think, things are good. CEOs and factory workers or management are upgrading their facilities, thinking, this is a little lull maybe for a lot of businesses before it goes higher. But I think the music's about to end. And when everybody's really bullish and they think businesses is just getting started, usually that's when the business goes for a nosedive. We go in for a recession and they realize they just spent millions on new facilities or assembly lines and all that stuff right when all their demand decreases. So there's a lot of things coming together. And yeah, there's a few key currents. I think looking at the big picture might be important. I think the stock market is getting pretty frothy. If we look at the charts, we'll actually take a look at the big picture and actually go to gold first. So gold, in a nutshell, I'm just going to flip to the monthly chart. Gold has been on a tear, for a couple of years. It's outperforming. It's becoming one of the best performing assets long term. Last time we saw this was like in 2007, just before a major stock market and financial reset in the economy. Gold is kind of a barometer, a global barometer, like planet Earth and the people on. It's like a beehive mentality. The whole world is nervous that something is about to happen, and they tend to move to gold. They move away from equities to some regard. They move away from currencies. They move away from even real estate. And they start to move to gold. They want something physical, something outside of the financial system. And gold is telling us that people are preparing for something bad to happen. We don't know what it is. We don't know, when the shoe is going to fall and trends are going to change. The economy situation is going to change. But gold has just been on this tear, and it's outperforming and it's extending to the upside. That is an early warning sign to be careful for the stock market. But if we zoom in now and go to the overall stock market, I'll go to the SPY, which is the S&P 500 ETF. We've obviously had a very nice rally coming out of the lows from this year. We had the big 20+% sell-off. Now the markets are pushing near hitting all-time highs, and really people are buying into this market up here. I think it's kind of camouflaged with, Oracle has now kind of just came out of nowhere. And, Larry, he's like, you never really hear much about him, it seems, now he's the wealthiest man in the world and he's like silent. And Oracle came out, and I think it's going to revigorate, some of the tech space and make people even more bullish on the market. And of course, it jumped like 30+% the other day. And so the markets are getting dragged up mostly by the big techs. We are seeing some broad market rally. We're seeing small caps. They've been moving up and equal weighted, but it still is really the magnificent seven. And so the stock market is in an uptrend. You do not want to fight it. You just need to have a game plan so that when things do stall out and price starts to roll over, first of all, you can identify when the trend up has come to an end and to have a game plan to at least avoid a crash or benefit from falling pricing. And then if we zoom into the shorter term here, Danny, we just look at the 30-minute chart really over the past week, the stock market has gone from this lime green, this oversold market condition where it's sold off too quick within this uptrend. Lime green is an indicator, is part of an indicator that tells me when the market is too oversold, is usually when value hunters step in, bargain hunters or institutions, and they buy it back up and you can see it's rallied. And it's done this a couple of times. When we just zoom back here on the S&P 500, it can get sold off, it can get into this oversold condition, and it gets bought right back up again. So we're still in kind of that buy the dip mentality. We did have an interesting scenario yesterday where we had this red indicator, get above this blue line. This is my FOMO indicator. This is everybody seemed to be piling into the market yesterday. They don't care what price they pay. They're using market orders, which means they're buying at market and they don't care what price they pay. When there's a ratio and this red indicator goes over 3, it's telling me that people are just moving in and they believe the market's going higher and they don't want to be left behind. And so usually after that, we have a little bit of a pause or pullback. And really it's kind of, as soon as we got up into that territory, the market's really been trading sideways for this last day and a half. We might actually see it pull back a little bit for another day or so. So, you look at long-term gold, be aware the music will come to an end at some point. We look at the daily chart. It's up, but it's a very weak market.
Chris Vermeulen emphasizes that gold has had a strong run recently and is now pausing in a sideways bull flag, which often signals it's ready for another breakout soon. While money has rotated into silver and gold miners, those positions may see profit taking, with flows cycling back into gold. Chris prefers gold, whether physical or through ETFs. They warn that if equities drop sharply into a bear market, even gold could face temporary selling pressure from panic and margin calls, but it usually recovers faster than stocks. Current conditions resemble 2007, where gold continued to rally even as equities topped, suggesting more upside before any broader correction. Let's dive into the interview.
No, so if we look at gold, all it's done is, we can look at the 30-minute chart over the past week and a half. Gold has had a very strong move. And after something's had a strong move, it's just taking a pause. I wouldn't say it's weakening. It's just taking a breather because it just had a hell of a run. It's exhausted. Right. There's just some profit taking. And so even when we look at the daily chart, which is very similar, we're just trading sideways. And it's a little tiny bull flag. It's primed and ready to shoot up literally, the next trading session, this thing could pop and run. And so I think right now in the precious metal space, money is actually chasing the gold miners and the silver miners. Gold's taking a pause. Money's rotating out of gold because it just had a nice move. And we're seeing it move into like silver miners and gold miners. You can see they're extending and pushing higher. And we were long SILJ. We just hit a 20% target yesterday. We've actually closed that position out. I think now we might see, miners take a bit of a breather and a pause. And as money rotates out of miners with some profit taking, we flip back to gold, and gold has got this little pause that it's just had, and now gold will probably shoot up. So I think they're going to like piggyback on each other. That flows into miners and then flows into gold and goes back and forth. That's what I think is going to unfold here. The problem is we're coming to a turning point, and when things turn, I don't want to hold anything. So I still like gold the most, physical gold or through an ETF. I think that has got good upside potential here. I think it still has 10 to 20+% upside. I also think because I have to hold it for a year, I think bonds like TLT would be a good position as well. So the bonds could come to life and really start a nice move up, and eventually it'd be nice to sell gold. And because when the stock market does roll over, eventually gold will most likely pull back with it. But gold holds its value fairly well. It doesn't drop as much as the stock market. So I would say like gold and bonds would be those plays. If you had a gun to my head and said you have to buy and hold, it's probably the two that I would do. Short term, typically we see gold, like we could see the stock market top out and potentially fall 10, 15% from here, and gold keeps going up another 10 or 20%. But eventually when the stock market falls a certain amount, and people start to get really scared, there's real fear, we actually enter a bear market, then gold usually doesn't stand a chance. There's enough selling and margin calls and fear that even people sell off the good positions like gold. And so gold naturally will sell off temporarily. But it's usually short-lived. Gold only gets pulled down during an extreme wave of selling. It could last a few months in the markets, and then it'll find a bottom way before the stock market does. So yeah, gold is not immune to a bear market, but it can rally. In this particular situation, 2007, which is a very similar situation as we have right now, when you look at from price charts and what the dollar is doing and what gold's doing in the stock market, the equities market could sell off and top at any point here, and gold just keeps on going another 20+%. So that's why I like gold at this point.
It is more crucial than ever to have a clear plan in place to safeguard profits and handle reversals as global uncertainty increases and stocks reveal underlying fractures. How likely is it that silver will maintain its pace toward $50 without seeing a dramatic reversal if it breaks over $44? In the event that U.S. stocks undergo a more severe decline, may gold and bonds serve as the most secure hedge? If you enjoy the content, please like this video, subscribe to the channel, and press the bell icon for timely updates. We appreciate your support, and thank you for being with us.